us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Inflation in America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500. 2 hours and 30 minutes away from CPI in America. TK, that report just around the corner.
It's like Howard Johnson's 28 flavors to measure. My measurement, somebody stopped me on the street last night and said, what do you look at? And I look at Cleveland CPI. There's different names for it, not the nowcast. Everybody's nowcasting. Do you know there's Bramo nowcasting?
We got a Bramo nowcast.
Bramo nowcast is a level of gloom that's out there. It's pretty high this morning, actually. But the answer is I look at Cleveland CPI. We're not going to go into the details now, but it's at 4.80% coming down. And if that comes down again off the data this morning, that's called disinflation.
Later on today, it's about the split, Lisa, the split between headline CPI elevated, led by gas prices, core CPI, potentially showing more progress for this Federal Reserve.
My concern is what levels are actually going to change the needle for people who are not going to look at one print. The Fed's going to say they're not going to look at one print. So my key question today is how big of a miss or how big of a hit of a boost could you potentially see a reaction from? In other words, where is the threshold and where is the market biased to, an upside or a downside surprise?
If this sets us up for the Federal Reserve next Wednesday, we need to set up for the ECB this Thursday, stuck between a rock and a hard place. Reports yesterday from Reuters that this ECB might have to upgrade their inflation outlook for next year to north of 3%, Tom. That's going in the wrong direction. And then moments ago, reports suggesting Germany will have to downgrade their outlook for growth this year to a contraction, never mind stagnation. We're talking about the biggest economy in the Eurozone in contraction for the year, and the ECB upgrading its forecast for inflation potentially Thursday for next year.
Former President Summers of Harvard leads the charge on this. I'll let Larry Summers speak about, does it smell, does it feel, does it look like stagflation? I think it does.
Smells like it, right?
Yeah.
What do you do if you're President Lagarde on Thursday?
The textbooks don't tell you. That's why people stop and listen to Larry Summers on this, and frankly others as well. Which do you attack? Do you attack growth? The politicians are going to attack growth every time, or do you go, OMG, we got to do something here? And the distinction here is this word austerity. You remember it, and it was the cant in London around Brexit. But are you going to goose the economy in Germany? That's anathema to their economic culture.
That's a conversation for a little bit later. Yeah. Let's start the conversation in the equity market on the S&P 500. Pretty muted price action. Equity futures here negative by 0.07%. In the commodity market, new highs for the year. Yeah. On crude. We're getting closer and closer to 90 on WTI, through that level in the past week or so on Brent. Lisa, right here, right now on WTI, 89.36.
Which is going to be a key component of the discussion at 8:30 a.m. when we get the CPI print and the headline number. How much has it been increased by the price of gas? I'm also looking at real wages, which is calculated once you take a look at inflation. And you can see they've started to tick down. And yesterday, the Census Bureau put out a report saying that U.S. inflation-adjusted household income fell last year by the most in over a decade. Keep an eye on this. Today, Barclays Global Financial Services Conference continues. Citi CFO Mark Mason speaking at 10:30 a.m. Yesterday, David Sullivan of Goldman Sachs talking about those capital rules, slamming them yet again. We heard that from Jamie Dimon, basically saying that this is going to restrict access to companies big and small. And at 2 p.m., this is the other thing that kind of has come under the radar, is real yields has really led this whole charge up in yields. And we're going to get the August U.S. budget statement. How much of this is just the U.S. is getting more in debt and selling more debt to cover that? And is this really going to get juiced as we see that increase later today?
Lisa, thank you. Looking ahead to AMH a little bit later this morning down in Washington. Need to talk about the potential for a strike in Detroit as well, Tom. Listen to this from Jim Farley of Ford. I think this line is so important. What these wage negotiations mean to them. There is a line in the sand for the sustainability of the company. The sustainability of the company. We heard that yesterday as well about the viability of the company. Can they really take on the kind of pay raises that UAW, Tom, is pushing for?
I interviewed Bill Ford once, and we've known each other for years. The guy is very good at pond hockey, John. You'd be great at pond hockey. You go north of Dearborn, way up in the Michigan.
It's like Mighty Ducks.
Climbs, like Mighty Ducks,
like Mighty
except
Ducks.
you're outdoors.
I know all about pond hockey.
No, you're outdoors, and you're on the ponds, and you're competing with old farts, and Bill Ford leads a charge on this. We're talking about pond hockey, and then we talked about the fabric of the family. We didn't go bankrupt. They did. And Farley's channeling that. Ford and Dearborn, they will do everything they can to avoid what they avoided back when Steve Ratner was car czar.
Back in the day.
Around
the financial crisis, of course. MH joining us next hour. Anne-Marie from Washington, D.C. Joining us now, Larry Adam, Chief Investment Officer over at Raymond James. Larry, let's start with 831. What are we looking for at 8:31, a minute after we've had that inflation report? What would you expect to see, and how would you expect this market to respond to it?
So I think, obviously, we're going to get mixed results when it comes to inflation, headline moving higher. But I would still focus on the core number because I think that number is going to continue to go lower. And I think that's the broader picture of what's happening with inflation. I think inflation is going lower. When you look at this economy, it is starting to slow. It's going to continue to slow as we go into next year. When you look at goods pricing, yesterday, the Adobe Digital Price Index came out, and for 12 months in a row, goods pricing has gone lower. More importantly, it's at a 40-month low. And then I think we're going to continue to get supplemented with lower prices with the fact that shelter prices are going to start to be reflected in these numbers. And keep in mind that if you look at real-time data like Zillow, this core CPI number would probably be below 3% if we were to switch out and put some real-time indicators in that. So I think that trend is going to continue to show deceleration in inflation.
Larry, bring it over to the stock market. And let's get real right now on nominal GDP. You know, nominal GDP ties directly into revenue growth, et cetera. Are we anywhere near the tipping point where we see substantial lessening of revenue growth because nominal GDP comes in lower?
I think we're actually going to go into a mild short recession going into next year. And to your point, I make it really simple. And that it's simple in the sense that, do you think you're going to spend the same or less over the next 6 months that you did over the previous 6 months? And when we do our proprietary surveys, most clients say they're going to spend the same or less over the next 6 months. Now, assuming that job growth remains constant, that means you're in a recession because after inflation, to your point, you're in a recession. So I think you're going to start to see this economy modestly struggle as we get into early next year.
Well, mildly struggle, that's fine. Give me an SPX update here. I mean, we're sort of at the atom level on the stock market. Can you get more enthusiastic as corporations adjust to your recession?
Now, to your point, where our target for this year is 4,400. I think one thing to keep in mind is that we've only seen 5% pullback so far year to date. Historically, you get 3 to 4 5% or more pullbacks in a given year. So I think time is there that you're likely to see some downward pressure in this equity market over the next couple of months. I think that'll set up a better buying opportunity as we go into next year. And to your point, when it comes to inflation, I'm not so sure if inflation comes in as people expect, particularly on the core, you're going to see a big rally. We've been rallying on the same news for most of this summer. So I don't think that's going to lead to a big upside just if those numbers continue to show a deceleration in inflation.
Larry, back in August when you came on with us, you were talking about how you became cautious, which is notable because you were really optimistic for a lot of the year. Does cautious mean buy tech? How do you express caution in an equity market that's been driven by the biggest companies that, albeit there was a somewhat soft reaction yesterday, have been really delivering?
Well, tech continues to be one of the areas that we do like. If you look at our favorite sectors, they tend to be the ones that have, in our mind, the most attractive valuations. Tech falls into that realm. I know some people think that's not correct because it has an elevated PE, but we always want to look at what is going to be in the future. And when you look at tech earnings, it continues to be that one sector that consistently beats its expectations. And when you start to apply the consistent beats that we've been seeing, tech's really not all that expensive. And that's one area where if growth gets constrained, that's one place where investors can look for growth. And I think you'll continue to see fund flows into that sector.
Well, here's an area that's struggling right now, Larry. Let me bring you some news. Spirit Air is cutting its third quarter total revenue forecast, blaming increased fuel prices and steep discounting. That stock is down about 2.8%. For anyone following the airlines on the S&P 500 down about 20% from the July highs. So the airlines have already been punished over the last couple of months, TK. Fuel prices are up, costs are bad. And ultimately, are we starting to see some pressure domestically that's leading to lower fares? On Inflation Wednesday in America, this is a big part of the conversation.
What I do is I go to Google Flights, real scientific, John. I go to Google Flights, I go New York to LA economy, what's the price? And the answer is lower. I mean, United Airlines doesn't have the problems of Spirit, but they're $275 and Spirit's $197. I mean, that's the price discount. That's a big discount for Spirit, but $197 to go that far?
Sure.
Who's making money?
Larry, talk to me about this. I wonder if this is a Spirit problem or if this is a broader story. We've got higher costs off the back of higher crude prices, higher fuel prices, and maybe testing our ability to pass them on to the consumer. Is there a story there for you, Larry?
Yeah, I mean, it's a pretty complex story. First of all, I do think the consumer is going to struggle going forward. Third quarter growth is going to be pretty healthy, right? We all knew third quarter was going to be healthy because everybody was getting out into what we call the summer of revenge travel too. But looking forward, as you mentioned, we've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
What gives you confidence that the decline in consumer spending, Larry, is going to be short-lived and shallow and not something deeper if there is some sort of true recession with a feedback loop?
Well, again, we think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer being the biggest part of the economy is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months. I think total growth being subtracted is going to be about 0.5% instead of 2.5%. And the total number of jobs being lost, we think it's going to be around 500,000. Historically, in a recession, you lose about 2.5 million jobs. So that's why I don't think you're going to see a total rolling over, deep rollover in consumer spending.
Larry, great to get your input this morning to kick off our programme ahead of CPI in America. Larry Adam there of Raymond James. Your equity market pulling back just a touch on a session at the moment near session lows. We're negative here by 0.2% on the S&P 500. The latest news in the last couple of minutes from Spirit Airlines cutting their outlook for their third quarter forecast, third quarter revenue off the back of increased fuel prices and steep discounting. That stock negative, Tom, by 2.8%.
I look at LAX. Bramo emails me. She goes, would you look at Paris? We're thinking late October.
Is this business class or first?
I look at business class. Bramo only goes business class.
Stop projecting.
I'm looking.
Exactly.
I'm looking at the international flight. I look at it used to be about $7,000. One ticket business class, $14,000 for a loving couple. It's gone from $7,000 plus to $3,148.
That's a change.
That's wow.
So that's international.
I think this weekend.
International arguably is where some of the strength might have been. Domestically, Lisa, where Spirit is focused, that's where the struggle has already been flagged.
Which is the reason why I liked your question to Larry about, is this a broader story, especially if this is an airline that caters to families, that caters to vacations, that caters to people who are watching their budgets. Are you starting to see more of a pullback there? We've seen mixed signals. Yesterday, Walmart CEO didn't necessarily have that kind of tone in an interview, but there is this feeling that there are people who are getting severely hammered by inflation and by wages that aren't keeping up.
How's your budget for this? USB-C to Lightning adapter, $29 on the Apple website.
Loved it.
$29.
Love the dongle.
You buying that? You getting the dongle, the adapter?
You think? 3 or 4?
For goodness sake.
But it includes a cord.
I thought it was fascinating.
But not the actual thing.
We could talk about this through the show. Inflation leads today. But, John, I thought the Apple soiree was fascinating. Ludlow killed it.
He was great, wasn't he?
Yes,
yeah, he's fantastic.
He's
Did a brilliant job. Tom Ford coming up a little bit later of D.A. Davidson on Apple from New York City this morning with inflation data a few hours away. Good morning.
Since the very first iPhone, we focused on giving our users a device that's incredibly powerful, remarkably easy to use, and beautifully designed. Every year, we've built on this foundation to create experiences that make a real difference in our users' daily lives. Today, we're pushing what users love about iPhone even further.
There's so much marketing buzzword stuff in that, Tom. Experiences. Beautiful. Apple CEO Tim Cook yesterday at their annual product launch announcing the new iPhone 15. The stock lower off the back of it. Lower again this morning by 0.5%. Tom Forte over at D.A. Davidson. Here's the quote, Tom. Killer quote. Unlike years past, we believe the company may not be able to rely on strong iPhone sales to drive its share price higher. That's the change.
We are doing the best we can on this, and when you have Mark Gurman and Ed Ludlow leading the charge, it is best in world analysis of this. And what Bloomberg Surveillance has done is get away from the blah, blah, blah and actually talk about what it means for the company, what it means for the stock, and frankly, what it means for America. Mr. Forte joins us now, senior research analyst, D.A. Davidson. He is a neutral on Apple. Let me cut to the chase. I thought some of it was fascinating and the rest of it was sort of eh. But Tom, to me, the key thing is what does it mean for the broader Apple ecosystem? I mean, I think there's when you have storage, everybody's complaining about 2 terabytes of storage in iCloud. They pop that sucker out to 6 to 12 terabytes. Little things like that below the headline. What's yesterday mean for the Apple ecosystem?
Sure. So I think that what I thought was most interesting is that they're taking a de facto price increase on the Pro Max. They're not offering the 128 megabyte model anymore, so it's $100 more to get an iPro Max. And then the dongle, you teased it before, but the fact we're talking about accessories, not the phone, is
right.
Good and bad news. The good news is that it should be accretive to margins. The margins on a $29 dongle ought to be fantastic. For the ecosystem, I think that you may not see the incremental new buyer this year, but as you pointed out earlier, the wireless carriers seem to want to subsidize their 5G networks, which is also good news for Apple.
I got 8
so some good and bad.
Yeah, I got 8 ways to go here, Tom, and John and Lisa have more intelligent questions. They got a 3 nanometer A17 chip. Is it enough for someone to upgrade in China? Is it enough for someone to upgrade sitting to my right here in New York where he's adamant he's not going to fall for the fanboy baloney? Is that new chip enough to upgrade?
I do not believe that it is. So when I was thinking about all the buzzwords and all the new things in the iPhone 15, I was chuckling at titanium and how there have been titanium golf clubs for some time now, or how they're essentially, no one's pointed out that they're offering OnStar. And so I'm concerned that there's a lot of small incremental adjustments, but there's no one item that I think is going to get you to wait in line, like we used to for an iPhone.
So, Tom, you know the bullish thesis. The bullish thesis sounds like this. There are tons of people who haven't upgraded. The iPhone 15 is going to get them to upgrade. Now, Tom, you clearly don't buy into that. So let's go through your rating. Neutral, 180 price target. In the pre-market right now, we're at 176. Given the multiple that this stock has and the fact that you don't believe in the bullish thesis, Tom, I've got to ask the question why this isn't a sell and why that 180 isn't a whole lot lower.
Yeah, so I do think, you still have an amazing balance sheet. So they have the potential to buy back billions of dollars of shares to support the stock. I don't think they would ever raise their dividend yield to, say, 3% to attract that pure dividend investor. But the foundation is still there. And I don't think that the stock is so overheated that would warrant a sell rating at this point.
There is this question, though, if there isn't anything to really catch everybody's eye, except for a $29 dongle, there is an issue of the increasing geopolitical concerns, especially as right after this launch, China came out and said that they flagged a number of unspecified security incidents with the iPhone. How do you factor that into a price target?
So the way that I factor it in is about 10% of their revenue comes from China. They're clearly still heavily dependent on China from a supply chain standpoint. And when you think about what I'm thinking of is protectionist behavior by the Chinese government, we have protectionist behavior in the U.S. as well when you think about banning TikTok and things of that nature. But to quantify it, 10% of their sales are at some level of risk, and that's bad news for Apple.
So if you're looking at right now a product that isn't necessarily going to encourage a real refresh kind of cycle, where is the bulk of the revenue going to come from? Is it going to increasingly come from services, or can it continue to come from just the fact that at some point this is going to break and even John is going to have to upgrade?
So, all right. So there is some element of the slow to upgrade consumer, but I think that this is why there was a lot of enthusiasm for the Vision Pro. But we still think that the Vision Pro, which looks to be on track for launch next calendar year, they're not going to achieve mass adoption with their augmented reality, virtual reality headset. So if you don't have the next new thing and you have kind of the iPhone aging on the vine, it's a challenging period for Apple. It's somewhat remarkable how well the stock's done, given that they already tipped off their hand that they're going to report their fourth consecutive quarter of declining revenue in the September quarter. So new products and I guess still a foundation on iPhone and buybacks might be the things that hold up the stock on a near-term basis.
Tom, that's worth 30 times forward earnings?
No, it's not. But yeah, so it is not. The services element is what enabled them to get the premium multiple versus where they were trading before. Services, it's still a good story, but at some point, either the iPhone's going to have to exceed all of our expectations, or the Vision Pro is going to have to do much better than I think for the stock to continue to go higher over the next 12 months.
Tom, let's just finish on this line that Lisa mentioned from China. I wonder what the response will be from Apple to this, because it's not something you typically hear. This is from the Chinese Foreign Ministry spokeswoman. We noticed that there have been many media reports about security incidents concerning Apple phones. Tom, what do you think they're alluding to?
Yeah, so I think they're alluding to the reports that government workers in China are not able to use Apple devices. I think it's interesting. I've been trying to figure out the appropriate chess piece for Apple in the increasing tension between the U.S. government and the Chinese government. They're clearly not a pawn. They're not the king. They're not the queen. Maybe they're a knight. But they have tremendous sway in China thanks to their relationship with Foxconn. But I think they're getting kind of caught in the middle here on this increasing tension between the two countries.
Without a doubt. Tom Forde, thank you, sir, of D.A. Davidson, following the release, the unveiling, the big reveal of the iPhone 15. That tension between China and the United States, Lisa, thanks for mentioning it, because that story is going to be pretty wild through the next quarter or so, just to see what those sales actually look like on the ground in China.
Especially if they're flagging unspecified security incidents right after we heard about not using these from government workers in China, but saying it's not an outright ban. I mean, they're basically specifying that. Is this sort of a tit for tat after selling the iPhone more aggressively in China? I mean, is this because of the new product launch?
I just think it's demand. I don't have a bullish bearish case here on China, what they're going to do, but you know, I look at luxury sales in China and all that, and frankly, it's a mystery right now. I think the Apple sales in China are the same as LVMH or Hermes or the rest
luxury
of
in
them.
North America, Tom. North America, never mind China. North America, we've seen that flagged by many luxury retailers.
Well, there's a small group at the top and the others. Yeah, there's
entry-level stuff,
split. Sure. Well, just whatever it is, but I don't have a lot of certitude on what we're going to see in China in the next 90 days on luxury, and frankly, an iPhone. The 15, Pro Max with 1 terabyte of storage, you're popping $1,400.
Is that enough for you?
For that puppy.
Is that enough storage?
And, I mean, Vet wants one, but the bottom line is that's a lot of money.
How much storage does one need? Isn't that a ridiculous amount?
Yeah, it's ridiculous. 256 will get it done.
Ridiculous.
For all digital
and
pack
for your
rats.
ego, if I want to go down the street, I need
but how would anyone
512.
know? You've got to tell everyone that's what storage is on your phone.
He has 512
nice.
1 terabyte.
They're T-shirts.
From New York City, future's a little softer. This is Bloomberg. First day of losses in 3 on the S&P. Let's see if we make it 2. Equity futures on the S&P 500 slightly negative this morning. Going into CPI, we're negative 0.2% on the Nasdaq. We're down about 0.25% on the Nasdaq 100. If you look at where we were since August 10th, Tom, where we are since August 10th, the last CPI report, this equity market's basically dead flat, Further signs of disinflation. Stock market's gone nowhere at the index level.
And Tom Forty talked about it with the thing everyone owns or doesn't own or wants to own, Apple, in that there's a wall of money out there. I'm going to give credit to Lawrence McDonald, as we did yesterday. And the bottom line is, as Larry wrote in a brilliant essay, there's just this wall of money holding things up, including, Lisa, would you say corporate spreads as well?
Yeah, everything.
I mean, just putting the bid on bonds and notes and bills, and, you know, it's just a wall of money.
You can actually get some yield. Let's turn to that yield. 2-year, 10-year, 30-year in the bond market. 2-year through 5%. Up another basis point or so at 5.02%. On a 10-year through 4.30. Up 2 basis points today. If you think about where the equity market has been since the last inflation report, dead flat, this bond market anything but. Arguably, Lisa, absorbing, internalizing the higher for longer message at the front end of the curve.
And the most shocking part about it is it has not disrupted riskier assets. I mean, pairing those two ideas really speaks to a tension right now. Can you have a soft landing with higher for longer? And that really is, honestly, increasingly at debate.
It's certainly stronger dollar off the back of it, that's for sure. You push this through foreign exchange. It's been an interesting week already. Monday, the US dollar was weaker. Tuesday, it was stronger. This morning, it's stronger again. The euro's negative by 0.2%. The euro right now, 107.36. I really don't know what the ECB can do, will do, should do at the European Central Bank in Frankfurt, Germany on Thursday.
I'm using Euro Swiss as a barometer. It has not moved. You got the German news of a slower economy, as you say, the complete mystery of the ECB. And my litmus paper there is the euro as compared to Zurich, and the answer is it has not shown strong Swiss franc.
Under surveillance this morning, 2 hours away from US inflation data. CPI expected to show price pressures remaining sticky. Adding to risk, policymakers will keep interest rates higher for longer. Over in Europe, starting in the UK, the economy shrinking at the fastest pace in about 7 months, reviving fears that a recession might be underway. And traders ramping up bets that the ECB will raise rates when it meets tomorrow, following a report from Reuters yesterday that the central bank sees inflation remaining above 3% next year. So tomorrow, Tom, we'll get these forecasts, and those forecasts will be available to the Governing Council when they convene to set interest rates. The idea being, if they have to upgrade that outlook for inflation to above 3, not at 3 for 2024, does that embolden the hawks to say, let's go, we need to go again?
I need some Jamie Dimon humility here. How valuable are those forecasts? Let's go back and look at the forecasts 6 months ago, a year ago. I mean, we're lucky we get the BS about it here. People have to actually make forecasts. Greg Bottle had the courage to come in from BNP Paribas the other day and say, I had to go bullish, I'm not bearish. What is the value of a next year 3% ECB forecast?
Well, have they missed? They've underestimated inflation, right? Time and time again. Hasn't that been the story in Europe?
They've underestimated the rigidities in Europe. This is a real economy issue.
They're underestimating how quickly it can come back down?
Yes, because of the rigidities. Trichet would say he would say it more romantically than me with that French accent.
Sure.
Rigidities, or however.
Is that how he would say it?
Sound good there?
I hope Trichet's not listening this morning.
I hope Catherine Deneuve is. Good morning.
Looking forward to our coverage of the ECB tomorrow. Let's take it back here to the United States. A strike by the United Auto Workers looking more and more likely as the union and the big three, they remain far apart on a new Labour contract. The UAW president planning to confirm the union strike at 10 p.m. Eastern tomorrow, 2 hours before the contract officially expires. This all according to people familiar with the matter. They've come down from 40, Lisa. They're at 36. I was speaking to David Welch of Bloomberg over in Detroit yesterday. I said, what gets it done, David? What gets it done? He said he reckons 20 gets it done. I have no idea if Ford, GM, Stellantis are anywhere near coming to the table and offering 20.
Especially because it's unclear what other details are on the table. There was a report about absenteeism and how absenteeism was about 23% at Stellantis. And that's one of the things that they want to remedy because this is costing them a lot of money. And they said if people actually showed up to work for all of their shifts, we would save enough money to offset this. Just it's the rancor sort of underpinning some of these discussions on both sides, really percolating out and showing how difficult it is to come together.
It's also, to your point, this idea of the fiction of a 32-hour work week, we want to be like the Germans. I mean, that's the bottom line. And maybe Stellantis of Europe is leading the charge on this. How do you make money in America on a 32-hour work week? Please help me.
TK, we're finally talking about the elephant in the room in the EV transition.
Yeah.
And it's such a difficult line for the president to walk. He wants this transition. He wants to establish his climate credentials. At the same time, he wants to establish and conveys union credentials. But we know these automakers are going to struggle to compete with their Chinese rivals. The Europeans are talking about it this morning. We'll have that conversation in about an hour. How do you do that? How do you square that circle? Isn't the elephant in the room that the EV transition is going to cost the workers that this union represents? And UAW get the joke, and they're trying to do something about it.
Do we know what the EV transition is? I'm not sure. I'm still not clear. You know, I just got they put all the Harvard Business Reviews on my desk at home. The bottom line is it's all AI, EIEV, EIEIO. Baloney. Nobody knows what AI is going to do. Yeah, thank you. But
Old
nobody knows
MacDonald had a farm.
What do we know what EV's really going to do?
Or
besides, what do we do with the lithium batteries?
Or what kind of demand there's going to be. Ultimately, how much angst is underpinning this negotiation? And you've talked about this before, John, about how is this going to be the last? What is the outlook for certain workers in an increasingly automated space at a time where the actual technology is also changing? We just don't know, and that is underpinning some of the concerns.
Let's get to the outlook for crude just quickly. The IEA, that's another one for you, Tom, warning that oil supply cuts by Saudi Arabia and Russia will create, quote, a significant supply shortfall and threaten a renewed surge in price volatility. The announcement coming a day after Brent touched a 10-month high above $92 a barrel. This morning, $92.58. TK, going into CPI in America, we have crude at the highs of the year.
Yeah, I take it off July 4th, I believe it was, and it has been a surge. Is it a moonshot in oil? Maybe not, but it is a surge in the price of oil. It's got to change behaviors. There's no question about it. Right now, we're going to stagger forward into April of next year. John Ferro and I are riveted on the North London Derby of April 24th, 2024, April 27th, 2024. Rubila Faruqi of High Frequency Economics says that when John and I are at the North London Derby in April of next year, we're going to have a two-handle on U.S. inflation. Rubila, no one believes you. How do we get to a sub 3% inflation by the time the tots take out Arsenal?
Good morning. Great to be with you. Thanks for having me on the show. What we're seeing right now is a little bit of a dichotomy between what's happening with headline inflation, what's happening with core inflation. The Fed's mandate is headline. Obviously, an acceleration in that is going to be a concern, but we are seeing the right signs on core inflation. Rent inflation, shelter, that's going to start to diminish. The pressure from that is going to start to diminish. We don't think, if you're traveling, if you look at airline travel, that is still very strong, but we don't think that's going to keep on going at the pace that it has been. The labor market is key to these data. The labor market is slowing. Our base case remains that as the labor market continues to slow, as wage growth also continues to moderate, even as inflation diminishes, even as real incomes are positive, we do think that inflation pressure is going to continue to diminish. We think we will be at a two-handle by the second quarter of 2024.
How does our study of real estate now, or our study of real estate at the North London Derby in April of next year, how does it affect what the Fed will do about 2.8% inflation?
The Fed is looking at, it's a difficult thing, right? Because they are looking at backward-looking data. They're data dependent. But at some point, they also have to, and they're talking about it, that this rent, this housing component, that is going to start, the lagged effects are going to start showing up in what we see in inflation going forward. But, whichever way you look at it, inflation is too high. The Fed has to, we think they're done hiking. They have to maintain this policy stance for some time. The question now is, are they sufficiently restrictive? Do they have to push forward a little bit more? We think they don't. We think they're done. The peak in the Fed funds rate is where we are now. It's just that, can they call victory on inflation? Absolutely not. They have to keep that, hawkish bias. They have to lean into that. But I do think that the message is, from our perspective, that they have reached the peak and they're going to stay here for some time until inflation starts to, is on a sustainable basis moving towards 2%. And we do think that that's going to happen over the rest of the year and going into the first half of 2024.
Rubila, about an hour ago, Germany put out an increased forecast or revised forecast for GDP this year to a full contraction of 0.3%. We were talking about how the ECB is grappling with the nightmare of central bankers, which is stagflation. How far away from stagflation is the United States?
I don't think we are close to stagflation at all. Look at the positive momentum in this economy. We have constantly underestimated that, the household sector, the business sector. I think what's really important to remember is that going into this recession, we saw such extraordinary support for households and businesses that household and business balance sheets were fortified, coming off a very, very strong base. And I think that's what we've constantly underestimated. This economy still has positive momentum. It still has positive job growth. We are concerned about the fact that if the Fed keeps pushing, what is going to happen to this deceleration in job growth and what's going to happen to unemployment. But right now, we are not seeing any signs of distress that would suggest to us that the U.S. economy is really hurtling towards a recession or a contraction.
One of the biggest debates right now among economists, and I even see this on the Federal Reserve with certain papers that are conflicting about how much of the Fed increases in rates have already trickled through to the economy, with some people saying most of them have already come through, other people saying no, the bulk of them is going to slam into the economy in the next 12 months. We were hearing from Bob Michael of J.P. Morgan yesterday on that front. Where do you sit?
I think a lot of that effect has already gone through. We've been talking about lending standards tightening. We're talking about borrowing costs, at very high levels, multi-decade highs. The consumer has still been very resilient despite those headwinds. So I do think we're looking at a different cycle. This is not a typical business cycle. This is not a typical response to over 500 basis points of tightening. This is not what we expected. So I do think things are a little bit different right now. We do still expect that these tightenings are going to affect the labor market. Things are going to adjust, and that's going to filter through to businesses and to households, towards the demand side of it. So I do think that we are going to see the effects. It's just that we've been surprised. The economy has surprised us to the upside over and over again. We're still looking for growth to decelerate pretty sharply in the fourth quarter. Based on the fact that the labor market is going to soften. But we are also prepared for upside surprises given what's happened so far this year.
Roberta, just quickly, what do you think is going to be captured in the forecast we'll get from the Federal Reserve next Wednesday?
I think they have to upgrade their growth forecast. They have to downgrade their inflation forecast. I think what happens with the Fed funds rate is important. I think they leave it where it is, given that they want the insurance. They don't want to give the impression that they are at the peak and that they're not ready to do more if needed.
Got it. Roberta, thank you. Roberta Faruqi there of High Frequency Economics. Looking ahead to the Federal Reserve next Wednesday. Get a set of forecasts, not just a decision. Tom, North London already complaining. Did you spell Derby with an A?
I thought that's the way you guys spell it.
E.
It's a Derby.
That's how we say it. It's not how we spell it. I feel like you knew that.
I'm learning every day.
I was told over the Bloomberg just to correct you quickly. So you understood
well,
before we
go
to London.
But you say why don't you say Derby? I mean, it's a Derby.
It's a Derby.
It's a Derby.
It's a Derby. Will Kennedy's going to join us shortly.
Is Merseyside a Derby?
It's a Derby too, Merseyside Derby.
With Everton?
Liverpool and Everton. Get Everton right.
Everton.
Nailed it.
I'm nailing things.
That's not Will Kennedy's team. Will Kennedy's going to join us shortly on the oil market. A warning about a deficit in the crude market. A deficit. Tom, not enough supply, and it's driving up crude prices again, 92.63 on Brent.
Francisco Blanch is brilliant yesterday on this. I mean, he didn't say 100 on the way, but look at that. 1, 2, 3, we're there.
How far away are we? Will Kennedy of Bloomberg just around the corner to weigh in on that. Crude prices elevated near new highs for 2023. Those latest prices going into a higher CPI print off the back of more costlier gasoline. We'll talk about headline inflation and the difference between that and core in the next hour of the programme. From New York City, this is Bloomberg.
The market is really tightening in the second half of the year. With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk tightening the market, increasing volatility.
We've had warning after warning yesterday from OPEC, today from the IEA. Toro Bassoni there, the head of the oil markets division at the IEA, warning of the deficit we could see in the crude market. Not enough supply. It's driving up prices. Let's talk about prices right now. 92.63 on Brent crude, WTI 89.44. New highs for 2023, even with supply in America near record highs and a slowdown, we're told, in China. Crude up, equities looks like this. Let's whip through the price action for you just briefly. Equity futures negative here by 0.14% on the S&P 500. Yields a little bit higher by a couple of basis points at 430. Going into CPI a little bit later on this morning. The estimates, Tom, look a little something like this. Headline month over month, because of this move in crude and gasoline prices, could come in at 0.6%, according to our survey. The previous number was 0.2. If you look at core month on month, totally different story. 0.2% previously, 0.2% is the estimate now in our survey. So the question is, do you ignore what's happening in headline? And do you ignore what's happening in the commodity market if you are the Federal Reserve? Particularly when the likes of Marko Kolanovic over at JP Morgan has this to say, Tom. Here's the quote. The potential for the commodity price surge to feed inflation and extend the hiking cycles over at central banks. Tom, is that the risk going into this Fed meeting next week? Or should we embrace that softer core figure for another month?
To me, the risk, as you put it, is it's two separate conversations. The conversation of our listeners on radio, our viewers on TV, is the real world out there. If I look at a gallon of gas, $3.84, the answer is my long-term moving average is $4.30, Lisa, down from the spike of $5. $4.30. We're a long way from that, but at the rate we're going, we could get there sooner than later.
Are higher oil prices inflationary or disinflationary? And this is at the heart of the debate for the Fed. But at the bottom line, if you have this appearance of inflation, that could create a self-fulfilling kind of prophecy in the University of Michigan Sentiment Survey, which you guys follow very closely. That's going to be important for at least politics, but also maybe the Fed.
Actually, Will Kennedy just fell off his chair in London because he's looking at petrol, they say. A gallon of petrol.
That is what we say,
a little bit higher. Will Kennedy, a gallon of gas in London, that's like $7 something, isn't it?
It is. But, I drive an electric car these days, so I'm not sure of the size price, but it's definitely going up.
How does Saudi Arabia, who seems to be in the driver's seat, no pun intended, how do they deal with Will Kennedy driving an electric car or China committing to an electric car? At what price of Brent crude do more people buy electric cars?
It's a good question, but I think that lots of us are driving electric cars in China, but the really important thing from the Saudi perspective and the oil market perspective is it isn't doing that much yet to dent demand. Demand is looking robust around the world. Gasoline demand especially is looking quite strong. Part of that is people switching out of diesel cars, which we've grown to hate, used to love in Europe, and now we hate them. But in China, people are driving more electric cars, but they're also driving more gasoline cars. They are moving around. After being locked up for several years, they are moving around again. And gasoline demand over the summer has been very strong in China. And I think one of the facts about the market right now is there was a lot of concern about Chinese demand. But when you look at the numbers, it's looking pretty good. And the Saudis know that.
Did the Ferro household have a diesel vehicle?
We did not know. We had a Rover 416.
But everybody went nuts on it. My father went nuts on it.
Did he get a diesel?
VW diesel.
We didn't do that. There was a big German push. Yeah. German manufacturers really pushed that stuff. Well, let's talk about supply deficits. I've seen two different numbers in the last 24 hours. There's quite a big difference between the two. OPEC have given us one. IEA's given us another. Well, you and the team running commodities in London at the moment. What's the number I need to be thinking about? How big will that supply deficit be through this year?
Well, I think the thing to point out is that even the IEA number is a pretty chunky deficit when you're looking at global demand in the sort of region to, just over 100 million barrels a day, 102, say, you're looking at almost 1% even on the IEA number, and that adds up pretty quickly. And if you split the difference between the IEA number and the OPEC number, you're looking at pretty chunky deficits, and that's what's driving markets higher here. And that's why it's clear that, the Saudi decision to keep that cut in place by the end of the year is severely tightening the market. And as Toro Bassoni said on the program earlier today, is driving down inventories very quickly. I think increasingly, though, the market's going to be focused on what that number looks like in the first quarter of next year. There will be some, year-on-year growth will not be quite as strong. There will be some more oil in the market, probably. And so that balance will increasingly come into focus. But there's no doubt, no matter which number you choose, if you look at somewhere in between, we're looking at a pretty tight market where inventories are coming down quick.
Will, are we back in the zone where we're going to be talking about the weather, and we're going to be talking about how cold the winter is going to be, and the value of not only oil but also gas is going to surge on that if inventories are so low heading into what has always been a big question mark of weather?
Yes, I think it's always a question, and a lot of people around the world use effectively what's diesel to heat their homes as heating oil. And the diesel market right now is a part of the oil market that looks extremely tight. Refiners are being rewarded for making diesel. The spread between diesel and oil prices has really blown out on just the global resilience in industrial demand as we, as the economy keeps going. And if we do get a very cold winter, that part of the market will continue to be under pressure. And yes, a cold winter always drives demand. So yes, we will start having that conversation. But it's worth pointing out that in Europe, the natural gas inventory situation looks as good as it could be for this time of year.
At the same time, when we do talk about heading into winter and some of the inventories and how depleted they are, I wonder about the lag effects, not of monetary policy, but of output cuts. Do we have a sense, Will, of how quickly the Saudi Arabia could turn on the taps and change that balance? Or is this something that could get a bit over their skis as they try to target a $90 to $100 price target, as we were hearing about yesterday?
Yeah, I mean, they're going to have to watch the market carefully. They won't, clearly they want to see prices rise higher than here. They won't want it to become a full-blown upward ramp, I don't think, because clearly then it does have an impact on the economy. But, the one thing you can say about Saudi policy is that they do meet their pledges and follow through, and they can adjust relatively quickly. I mean, it takes a number of weeks for them to get the oil on the tankers and to market, but they are able to respond, and they do tend to do what they say. So although they're committed to this 3 months, they always reserve the option to readjust if the facts change on the ground.
A monthly review, I think we're told. Will, I'm also watching the weather, but somewhere else. Hurricanes forming and potentially heading towards the United States. And as we know, the SPR was built up for a reason, Will. I'm sure it was in the midterm elections a year or so ago. And Will, that SPR has been depleted. I just wonder, from your perspective, given where crude output is in America near all-time highs, just how vulnerable the market might be with the SPR as low as it is.
Well, I think there's enough in the SPR to cope with a hurricane season, because also there you really need oil products if the refineries are knocked out, which is often the greatest risk. But what I would say is the market is very right to focus on hurricanes, and that Gulf of Mexico region is becoming ever more important to the global energy system. You've got the refineries on the Gulf, you've got oil production in the Gulf, you've got oil export terminals for shale to get to the rest of the market, and you've got LNG export terminals. So those hurricanes absolutely need to be watched across all sorts of markets, and a really big hurricane blowing up, in the Louisiana, Texas area could cause a lot of havoc, and we're not at the end of the season yet.
That's where the supply boom is currently. Will, thank you, sir. Will Kennedy there on the latest off our London desk on the commodity market. TK, output in America, thank goodness it's near all-time highs, given what we're seeing develop elsewhere.
To the late Bill Richardson, former energy secretary, governor of New Mexico, dying last week. To Bill Richardson and others who were energy secretaries, one of the charms of America is we never really had an energy policy. We just went out and did technology, and pretty much like the internet, nobody saw the technology of shale coming. Now what?
92 is now what on
now
Brent.
What?
89 is now what on WTI. And Lisa, to your point, I've been asking this question. I think it's an important one. I agree with you. Is this crude price a reflection of the extension of the cycle or the recipe to end one? And that's the question I've been asking as well to a lot of the guests that come on the 9 o'clock. Bramo, which one is it?
If it's driven by supply cuts, then you could argue it has a greater chance of ending the cycle because not driven by strength.
We'll continue this conversation. Gargi Chowdhury of BlackRock joining us very shortly. Crude at new highs for 2023. Equity futures slightly lower. We're down about 0.1% on the S&P 500. Inflation data in America 1 hour and about 34 minutes away from New York City. The second hour of Bloomberg Surveillance up next.
Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The most important data point of the month coming right up. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P slightly negative by 0.1% on the S&P 500. That data is 90 minutes away. TK, that data, US CPI.
It's going to be nominal data there, the core number, and then and on top of it, the inflation number. We've studied it all. We'll give you, Michael McKee's treatment here at 8:30. Just printing moments ago, the 10-year real yield, John, pops up to a 1.96%. That's a 2 basis point move here, and that's underlying churn here between nominal analysis and real analysis. We'll do that at 8:31.
And the difference, Tom, between core and headline within the data itself. Core, we're making progress. Headline, do we have a problem? Lisa, Brent Crude, 92.65. WTI, 89.50.
There's a big debate. Does headline matter? If you do see a pop upward in response to higher oil prices, do we care? Does the Fed care? And we talked about how you hear JP Morgan analysts saying that maybe the Fed's going to game out oil prices and respond to them. The issue is, it's how they are increasing. Is it increasing in a way that reduces consumer spending? And do you see that show up in the numbers?
On the commercial break, John Farrell's looking at what Lando Norris is doing as he goes to Singapore for the Formula One this weekend. What am I doing? I'm looking at a log gallon of gas, Lisa, and we're up above 2 standard deviations, above $5 a gallon gas. We're at $3.84, just teens-weens above 1 standard deviation. Now's when the tension starts.
What Tom just said, reverse it. I was doing one thing and Tom was doing the other. I was also reading this from Andrew Hollenhorst just moments ago. He says this about the Federal Reserve going into next Wednesday. The Fed is very likely to skip hiking this month, but stronger core inflation could convince the Fed to leave the 23 median dot, showing another 25 basis point hike in November. We've got to work out what this oil story does to demand. I think this is so important. So let's pick a company. Already this morning, in the last hour, we've heard from Spirit Airlines, domestic-focused airline here in America, citing increased fuel costs, steep discounting, and cutting the outlook for revenue. Lisa, that stock is down 2.95%.
And this is such a confusing picture because you've seen some airlines getting beaten up more than others. But you raise such a good point, which is, do you see discretionary spending coming in dramatically? Or is that strength and that surprising resilience that Rubila Fariki was just talking about, do you see that come to the fore and that actually consumers are able to keep spending well past what people expect?
Let's get to the price action this morning. Futures a little softer. We're down by 0.1% on the S&P 500, 87 minutes away from that economic data. Futures pulling back just a touch. In the bond market, yields higher by a single basis point, 429.42 on a 10-year. In the FX market, tons to talk about in Europe. We'll save that conversation, but I'll tell you where the euro is currently. It's slightly weaker against the dollar, Lisa, 107.38.
8:30 a.m. in about 90 minutes, we do get the key data point of the day, arguably of the month, as you were just saying. U.S. CPI comes out. People are going to be parsing through the headline number as well as the core figure. I'm also looking at how it compares to the pace of wage increases or not. And this, to me, is important because it's basically a question of, does this inflation reduce the spending power of the average American? If it does to have a different response from the Federal Reserve. Today, we do hear from more banking executives at the Barclays Global Financial Services Conference. We do hear from the Citi CFO, Mark Mason. Yesterday, Goldman Sachs' David Solomon talking about the resilience that we're seeing in IPO markets, but again, raising this warning about increased capital requirements and how that could hamper the access to capital markets by companies. And we've heard this a lot from a lot of banks, but maybe it's a little bit different. And 2 p.m., Tom, you were talking about the real yields. And I'm also looking at the real yields on 10 years, on 10-year treasuries. How much does it have to do with the deficit in the U.S.? And at 2 p.m., we get that August U.S. budget statement. As the deficit increases and as you have other regions move away from buying, like Japan, what does that do to the real yield? How much can that drive some of the gains that we're seeing?
I get that the debt and the deficit discussion is going to be huge and politically huge for it, but I'm going to go back to Jeff Curry of Goldman Sachs, who said this real yield, John, permeates everything we do, including buying the next iPhone. I mean, the real yield is different. It's back to our Ute. It's back to 1994, 1984, et cetera. It's a whole new world after all.
I know Jeff is no longer at Goldman, but I know he often tunes in. Can we give him a victory lap for his crude call? What a forecast. Ultimately, we're up here, aren't we?
Call.
In the 90s, going into the back end of the year.
Each of these guys is different. And Jeff Curry, I don't know what he's going to do. Maybe he's going to go teach microeconomics again at Chicago, but he brings microeconomic foundations to the debate like no one.
Gargi Chowdhury joins us now, Head of iShares Investment Strategy Americas at BlackRock. Gargi, wonderful to catch up with you. It always is. Two-part question. One, what do you expect the data to look like later this morning? And two, how do you expect this market to respond to it?
Sure. Good morning, Tom, John, and Lisa. So for the CPI data this morning, I think the expectations are for a stronger than expected headline. I think that'll be around 0.6. Obviously, the market will put a little bit more focus on the core data. I think that's where we get a strong 0.2. Now, after 2 months of that weaker, about 15, 16 basis points, expect this one to be closer to 23, 24 basis points. What I will be focused on is really looking at some of the details. So where are we seeing weakness? Are we still seeing that goods weakness? Are we still seeing goods weakness, especially in used and new cars, which is my expectation? And then focusing really on that shelter and more specifically on the owner's equivalent rent. And obviously that moved up a little bit last month. To see if OER comes down a little bit this month will be important. And then finally, last point I'll make is that despite the weaker data, especially on the core front last month, bond markets really didn't have the reaction that you would have expected. So I think this month it's going to be all around seeing how the bond markets react if we get that 0.2 expected data print.
Gargi, your research notes all 1994, which is the last time the Red Sox and the Yankees were fighting for first place in the American League East. I hope you love the doubleheader yesterday at Fenway Park. The bottom line, Gargi, is I'm looking at a research note talking how quaint the belly of the curve. Teach us about the value of the midpoint, the belly of the curve.
Sure. It was great to actually be in Boston, where I'm joining you from for that. But sadly, I did not get to go to the game. I was at a client event instead. But I'll say about the belly of the curve, the part that we're talking about is really that 3 to 7 year point. And, we look at the iShares ETF IEI, which gives you access. And the reason we're talking about the belly, number one, that's where the carry we think is the most advantageous to investors. So you can hold that 5 year point, or you can hold anything from that 3 year to the 7 year point. Rates can still move higher. And I think that's a really important thing for us to remember. Rates can still move higher by about, call it 60 basis points or so for the next 12 months. And you can still have a positive outcome in your portfolio. So that's number one. Number two is, and as you know, Tom, we've been speaking about this before, we'd come into this year and we talked about this, bonds are back in yield of dreams, but we'd really focused on the very front end. And now we're telling investors to move out a little bit and add some duration in that 5 year point, in that belly. And that's primarily because I think with the consumers slowing down in the in the fourth quarter of the year, as well as inflation moderating, or at least core inflation moderating, all that behooves a little bit more duration. Wouldn't go out past the 10 year point quite yet. I heard you guys talking about the deficit issue earlier, obviously Bank of Japan and their actions. There can be a lot of reasons for the longer end to continue to move higher and the yield curve to continue to move steeper. So the sweet spot is really that 3 to 7 year point.
If oil prices keep rising, as they have over the past couple of weeks, what does that do to your call?
Yeah, I think that's a really important point. I think it depends on how it rises. So whether it's like a grind higher or a sharp move higher. The second point will be where it gets to. I think if we sort of hover between $90 to $100, obviously that's a very high number, but I think that this is an economy that can still withstand that. If we're looking at an oil shock at 120 or something, significantly higher than today's levels, number one, I think that becomes a huge problem for the Fed. They haven't historically focused on headline, but they would have to, and that brings in a question of many more rate hikes. And the second, I think that also brings up a question of, again, the consumer slowing down. That is a huge tax on the consumer at that 115, 120 level. And I think that then brings us to a point of buying duration again, because that means that growth slows down pretty meaningfully. Everything that we're talking about for Q4 having a 1+ handle on growth, I think we would have to question that. So I think, the very front end would certainly suffer because the Fed would have to raise rates more than what's priced in. But I still think that the belly could probably be okay, especially when you think of the carry that's priced in. And then the last thing I'll say is, one of the things that we've also talked about in our research note, and we've been recommending since sort of our mid-year guide, is talking about owning tips, owning real rates here. And especially as we move closer to that 2% level, I think real rates become really attractive in a diversified portfolio. And again, if you have that real rate allocation in your portfolio, I think that can work out pretty well in that higher yield situation as well.
Do you notice fewer potential buyers when you're visiting clients? I know that you're in Boston and you mentioned the Bank of Japan. Are there fewer international buyers, and are there enough domestic ones to take over?
I think that that's exactly what's beginning to happen now in the fixed income market specifically. Obviously, we talked about how some of the international buyers may be stepping into their own domestic markets, given the yield availability in those markets. But I think if we look historically at who owns treasuries, if you look at households, that they have historically been a buyer of treasuries, and they haven't really bought as much yet, and they have a lot more room to add. And let's be honest, if you look at the last 15 years, last 10 years, there was really not much need for investors, households particularly, to own fixed income at 2-1%. And I think now at above 5%, sitting in the 2-year point or a little bit lower than that on the 5-year point, I think households will gravitate towards owning fixed income, not just as a diversifier to an equity risk, but a real source of income. And I think that's why obviously there can be volatility in the short term if we continue to see actions from the Bank of Japan or other central banks. But I think for the most part, I think there will be buyers coming in the U.S. market.
Or as a wise lady at BlackRock once said, the yield of dreams, Gargi. The yield of dreams. Gargi Chaudhry, Gargi, thank you, of BlackRock. Gargi's words, not mine. If you're just tuning in, welcome to the programme. On the S&P 500, equity futures here lower by 0.16%. The conversation will continue. Daryl Cronk of Wells Fargo in the next hour. In just a moment, coming up next, we're going to catch up with Bloomberg's Anne-Marie. Can someone help me and translate what on earth is going on at DCTK? The impeachment inquiry launched by House Republicans.
We've seen it before, but it's like on steroids. It's the same debate as before. Anne-Marie is encyclopedic on this, but it's just been amped up, ramped up. Of course, all of this leading into the election next November.
Got to talk about that one and this too, the prospect of strikes Thursday night in Detroit.
Yeah,
it's like right there. It's right on the horizon.
There. It's right there. And you mentioned your good conversation with our great team in Dearborn, Southfield, and Detroit. And the answer is, is it like the cable TV thing? They get it done so we can watch the Jets go down in flames.
And record viewership, I think, on ESPN for Monday Night Football off that game.
Well, that's the
Bills,
power
Jets.
of sports, but
sure.
UAW doesn't have that romance.
I think this
really
dispute is slightly different, Bramo,
I don't
between
think...
ESPN and carriers.
This doesn't feel like a marketing tool, and this doesn't
Not
feel
at
like just sort of a positioning kind of drum, beating of chest. They're really far apart. When you look at the details, it actually makes you feel like they're even further apart.
Can we close that gap in the next couple of days? Those two stories coming up next with Bloomberg's Anne-Marie. AMH just around the corner. US CPI about an hour and 16 minutes away. Equity futures negative here by 0.2% on the S&P 500. In the commodity market, crude making new highs for 2023. From New York City, good morning.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest from the nation's capital coming up shortly with Bloomberg's Anne-Marie. That was House Speaker Kevin McCarthy.
He looks tanned like John Boehner.
He's on a vacation, is he?
I'm wondering what's going on. He's getting the Boehner look.
I'm not
there
sure how
bit.
rested Speaker McCarthy is after the events of the last
baseball.
24 hours.
Wow.
I understand. We'll talk about that in a moment. Equity futures right now on the S&P, 1 hour and 13 minutes away from inflation data in America. Equities pulling back here by 0.2%, just a little bit softer. Dollar stronger, euro weaker, tons to talk about in Europe. We're talking about recessionary environment through the whole of this year in Germany in the latest forecast set to be unveiled later this week. We're discussing the Reuters report that came out yesterday, suggesting that when we get new forecasts from the ECB tomorrow, they will be upgrading, not downgrading their CPI outlook to north of 3% for 2024. All of that still to come in the next 24 hours. Tom, your yield on a 10-year, 4.30.
Oh, there it is, and the real yield again elevated as well into this key inflation report, 1.96. So enough of the chit chat. We need to go to our Bloomberg soap opera correspondent, Anne-Marie Horton in Washington as well. For those that are an inside baseball, Anne-Marie, and we know everybody listening and watching is, how close is Kevin McCarthy to the edge of Boehner?
Well, that's a great question. I would turn to Matt Gaetz, representative from Florida, who says that he wants to come in. It's going to be the prayer, the pledge, and the motion to vacate, meaning he is looking to potentially ouster and have this motion to vacate, ouster Speaker McCarthy from the job. And he gave this fiery, hot floor speech yesterday saying Kevin McCarthy is not in line in doing the job that he was elected by those members to do, which is potentially why everyone says you see McCarthy yesterday, first day back, going to the podium and without a House floor vote, which he indicated that he would take this to the floor first. He just launched an impeachment probe into President Biden.
I got 8 ways to go here, particularly for our international audience. We don't need a civics lesson on Boehner of Ohio down in flames. He had to get Democratic votes, folks, to get things done as a Republican Speaker of the House. But, Anne-Marie, just cut to the chase. How big is this group of Republicans? Is there a dearth of Republicans in name only in the House?
Well, the issue, Tom, is that every single one of them wants something different. So a member of the House Freedom Caucus, which many would say these are far-right members of the of the Republican caucus, Ken Buck says there's just no evidence right now to go along with an impeachment inquiry. You have others that are more focused on not wanting a continuing resolution. Scott Perry, the chair of the House Freedom Caucus, saying we're not going to go on with a continuing resolution. We want deeper spending cuts. We don't care about the deal Speaker McCarthy cut with the administration when we were discussing this back with the debt ceiling drama. So every single member has some sort of provision they want in order to get their vote to say keep the government open. And that is what makes this so difficult for Speaker McCarthy to navigate.
One of the things that you do best, Anne-Marie, is to strip out the noise from the signal and to focus on what's the political drama, the soap opera, the theater versus what is real. Is it fair to say that the impeachment is theater and most everybody in Washington, D.C. is treating it as such?
Well, it is because it's an inquiry at the moment. And even if the House was to have a vote on impeachment, there's no way there's going to be a conviction in a Democrat-held Senate. So this is an impeachment to nowhere. It's going to be a ton of theater in the House Judiciary Committee, in the House Oversight Committee, James Comer, Jim Jordan. There's going to be subpoenas for a number of bank records, et cetera. But a lot of this is going to be noise. At the same time, while there's no evidence yet, potentially keeping this in the news, the Biden administration is going to have to deal with it. And so is the campaign, because obviously he's running for re-election in November of next year.
So that's the theater side. And here's the real side that a lot of people are looking at right now, away from the political circus, which is the UAW strike and the potential for some sort of breakdown in negotiations. Goldman Sachs put out a report saying that a potential strike would reduce quarterly annualized growth by 0.05 to 0.1 percentage point for each week it lasted. This is going to have a material effect on growth. What is the response from the Biden administration, and what is the response from the Republican leadership?
Well, Wally Adeyemo recently said, and he's the one we have this week on the record talking to CNBC, saying that he does not think there'll be a strike. There are still negotiations. But the reporting we have from our colleagues out of Detroit is that they are very far still at this moment, and that Sean Fain, by 10 p.m. tomorrow, will have plans in place if there is no agreement to go on strike. Maybe not at all three, maybe not at all plants, but a certain number of plants. There will be strikes and walkouts if they do not have this agreement. Between the labor workers, the union, and the big three, they just are not coming in on the hard demands that both sides have laid out. And Sean Fain has said that we are willing to strike over this. This is going to be a difficult position for the White House. The president wants to make sure that he is on the side of the union, but at the same time, he doesn't want to see growth impacted because of this or strikers on the streets in Detroit. And he also wants to, the crux of this is move the auto industry into a greener future. What you saw at the end of last month was $15 billion to retrofit those factories instead of having these companies go to the South and do these joint ventures for battery operations for EVs. And last month, almost a month ago, it would be a month to the date of the contract expiring, the president put out a statement, and he talked about how its union workers should get the first shot at any of these jobs, and there needs to be a just transition, and that union workers should have the wages they deserve to support a family. You could see the line he is trying to walk as he's trying to balance two big goals of his administration.
I'm not sure how he walks this line, AMH, without picking a side. You've got the auto manufacturers in Detroit warning about the sustainability and viability of their companies as they make the effort to make the transition. How does he carry on walking this line without picking a side?
Well, it would have been easier for him if an Inflation Reduction Act, which some Democrats wanted, which was an extra bonus tax credit for those who bought electric vehicles that were made by unions. But guess what? Toyota has a huge non-unionized factory in West Virginia, and they were never going to get Senator Joe Manchin's vote on that. This is the predicament for President Biden. At the end of the day, there's going to be a lot of phone calls that are going to be worked between the big three and the UAW. He's already tasked Gene Sperling to be in the middle of this, but so far, there's still no agreement.
Has the president made it harder for himself by continually saying that he is the most pro-union president in the history of this country?
Potentially, if you're going to see a strike and if the UAW feels like they're getting a lot of pressure from the White House to settle for something they do not want, they can say to the president, well, you're supposed to be backing us. At the same time, really, a big bedrock of this discussion and a source of serious consternation for UAW workers is being left behind in the EV transition. And what we've seen from this administration is the biggest industrial policy when it comes to EVs, climate change since the end of World War II. And that is why it is so complicated for the Biden administration.
It could potentially be a massive test for his position later this week. AMH, Anne-Marie, thank you. And the position, of course, I'm talking about is the position of someone saying that they are the most pro-union president in the history of this country, Tom. Let's see how the White House responds to a potential strike later this week.
The election's down to 10 states, I'm going to say, as an amateur. Greg Giroux at Bloomberg is expert on this. But the bottom line is those states have a tendency towards manufacturing Rust Belt and even the romance of it, the look back, the image, the heritage. And so he plays to that. And so does Mr. Trump as well.
AMH, thank you. As always, down in Washington. Coming up shortly, Megan Robson of BNP Paribas on the credit market. Plenty to discuss there. And we've had a ton of supply issuance from corporate America through September so far. Your equity market slightly negative on the S&P 500. We're down by 0.1%. Inflation data in America 1 hour and about 4 minutes away. Inflation data in America 60 minutes away. Going into it all, your equity market looks like this. Good morning to you. Futures on the S&P 500 slightly negative by 0.1%. Similar move on the Nasdaq, softer, lower, negative by 0.12%. Look out below in the equity market if you get a big upside surprise on inflation later. Let's see if we get that. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 2-year still stubbornly around 5%. Just won't go away. 5.03% on a 2-year, up a single basis point. And for all the talks of getting bullish bonds, BMO, call it a screaming buy.
Screaming buy.
Morgan Stanley, call it a buy.
Oh.
Wells Fargo, call it a buy. JP Morgan Asset Management, Bob Michaels sitting around this table yesterday, called it a buy. And here we are, through 430 again, Lisa, up 2 basis points, 430.21.
I love this. I love that you framed it that way. For all the buyers out there, yields aren't budging. And so it raises a question, who's not buying and how much is this an international withdrawal? A Japan, for example, versus something more persistent that maybe has legs.
Sets us up for the Federal Reserve a week away. The week away for the Federal Reserve, for the ECB, a day away. And it's getting harder and harder as we inch closer to that decision. The euro looks like this. The euro against the dollar, 107.37, negative 0.16%. Late yesterday, a Reuters story. A Reuters story. Bear in mind there's meant to be a quiet period, but there never is. Because whenever they want to communicate, they can just leak whatever they want to leak to various media outlets, including this one. Cynical. It's real. It's reality. It's what's happening. Reuters come out and say that according to official close to the decision, we're going to get an upgrade to the inflation outlook for 2024, north of 3%. Which reintroduces the risk that we get a rate hike tomorrow, Tom, from the ECB. And that risk is now on the table in a more profound way, more pronounced way, at the same time that we have reports that Germany is going to be downgrading their growth outlook to contraction for 2023. That's the mess that President Lagarde has to confront in 24 hours.
And the overlay with the drama of Mr. Putin meeting the gentleman from North Korea and all the imagery that we see of that meeting is completely unspoken as this war advances. Overnight, there were legitimate missile attacks on Crimea by Ukraine directly at the Russian Navy. And I'm sorry, that's an overlay to the strategy Lagarde has to impart on the herd of cats she has to herd.
It's been the story of the year, hasn't it?
Yeah.
The fragility, the energy backdrop.
I just don't think we talk about it. We do finance, but the fact is the war is going full bore.
Well, it's all connected, isn't it?
Yes.
Without a doubt. Under surveillance this morning, the latest CPI reading from the United States is less than 1 hour away. Higher gas prices expected to help push month-over-month prices to 0.6%. Core is where the good news is for this Federal Reserve, at least a 0.2%. Do we focus on core or do you focus on headline and what's happening in the commodity market?
I think it's a great question. Or do you focus on both? And when does headline start to matter more for the Fed when it comes to the potential for rate cuts next year? Can you see rate cuts with headline figures that are sticky on the heels of oil prices? I don't know the answer, and this is something that maybe we'll get a sense of today.
Need to get to this story. So earlier today, we heard from Spirit, which had to downgrade its outlook for revenue and had to do so because of higher fuel costs and ultimately maybe even lower prices. This from American Airlines just moments ago. This is the new range for EPS, 20 to 30 cents. The previous range, 85 to 95. That stock is down by 3.4%. That, Tom, is another downgrade from the airlines. And this market was in front of it. We've had a 20% move lower off the highs of July for the airlines on the S&P 500, off the back of higher costs, thank you energy, and maybe even lower ticket prices.
And what's so important to me here is capacity is actually up. There are fannies in the seat. John, I'm looking at a chart of American Airlines back to 2014. And let's be clear, this was a train wreck, no pun intended, before the pandemic. Since the pandemic, they've enjoyed going from 30 to 10. Maybe they rebounded a little bit, but they're rolling over now at a 13 level, back on their way potentially to break support and go down to pandemic worry levels at American Airlines.
Fuel prices up, Tom. They've also got to recognise, Lisa, in the third quarter, a $230 million retroactive pay expense as well. It's kind of all going in the wrong direction at the moment for these airlines. Labour unit costs up, jet fuel prices up, and maybe tickets not going up with it?
Well, they can't. They can't. And we've seen this because we do get some consumer pushback. That's what we're hearing anecdotally. And at first we said, yeah, right, prices aren't going down. And then anecdotally, when you start looking at prices to Paris, as Tom does every day, you start to get a sense maybe they are going down. The idea of this raises a question. Is this just the airline industry? And they were one of the outliers in terms of the strength. If they're fading, is this really just a specific industry issue, or is this a broader question, especially with the UAW and the labor pushback, considering that that's really going to eat into their costs, into their profits?
This conversation is coming at a perfect time for the inflation debate that we're going to have throughout this morning with CPI about an hour away, Tom. If you're looking at fuel right now, can you really pass this on? If costs are going up in corporate America, labor costs one, energy costs two, can they really pass that on to the consumer? Is that consumer price tolerance still out there in quite the same way? Arguably, relative to where we were 12 months ago, the answer to that is no. But how much has it changed, and how much weaker will it be going through year end?
Well, I don't know if the airlines are a good example because, like I said, they're flat on their back near pandemic lows, unlike the Standard & Poor's 500, unlike the 7 glory stocks and everything else out there. But I think it's a sum of the parts. Why are used car analysis different from airline analysis? And the answer is used car prices, I believe, are maybe imploding is too strong a language, but they're disinflating.
Well, but it also points to the different economies and the different rolling recessions. Cars were what people bought in the pandemic. They couldn't travel. Then it was the revenge travel, and then they pulled back from some of the cars. My issue is, are we seeing the point at which margins have to compress more than people have previously thought? We see this with American Air. We saw that with Spirit. We've seen this across the airline industry. But it's not just there.
The back of this is disinflationary tendency. Perfectly timed. Megan Robson joins us, head of U.S. Credit Strategy, Senior Vice President, Disinflation at BNP Paribas. And what's so important here, we had on a guest earlier who frames out there somewhere next year a sub 3% inflation. What does your credit world do if we get airline disinflation, used car disinflation, aggregate disinflation, as some are suggesting?
Well, I think we're starting to see, Tom, signs of that with inflation coming down. I think a side effect that goes underappreciated is revenue slowing. And leisure has been a main top performer among high yield over this year, but we're starting to see early signs of weakness in some of those more cyclical sectors. So gaming is an example where we're seeing softer demand in some regions. I think airlines is another great example that could be impacted further by this risk of higher energy prices. But as revenue slows and you get some of these deflationary pressures, we expect margins to compress. And at the same time, you have a maturity wall that's approaching into next year.
Are the spreads at such tights, basically price to perfection types of level, if you just take a look at the extra yield over benchmark treasuries, are we really accounting for margin compression in corporate America in the credit sphere?
We don't think so. So we do see downside for credit spreads. We're forecasting wider spreads into year end. We think that decompression should play out. To really break out of this more narrow range, though, we do think we need to see more material weakness in the consumer. So we are watching for that as a catalyst, but risks are negative. I think in addition to all these dynamics, you have investor positioning, which has gotten much longer, and then this dynamic of rates being elevated in combination with margins.
High-grade companies coming to market, tons of supply. When does high yield come to play?
So high yield, we had a large investment grade calendar, very well absorbed, spreads unchanged on the week. I think what's interesting about investment grade is despite all the supply, you didn't see much on the long end of the Treasury curve. So decision makers are still reticent to really commit to issuing long-term capital. We have seen high yield supply start to come back to market this week, which is a good sign. Most of that has been on the refinancing side and higher quality. So we've yet to see sort of that expansionary type of supply from lower quality issuers, unsecured bonds.
If they came to market, could you give us an idea of the average coupon? What would it be, like 8%, 7-8%?
So I think it depends by the rating, but we're looking at around 8.5% for the high yield market broadly.
Can they live with that?
Well, I think that the lack of real pickup in high yield tells you that high yield issuers don't want to unless they have to. So I think there is, issuers can come to market and access borrowing so far if they need to. But over time, we're going to see that higher coupon, as it's digested, will eat into interest coverage even more than it already has. So we've seen interest coverage drop by about 1 times in the high yield market to about 4 times interest expense over our EBITDA over interest expense.
Are you managing for total return or to clip the coupon?
I think it depends on, it really depends on the investor mandate. So there is this debate.
My mandate is not to lose money like I have the last 3 years in bonds. Continue.
So I think heading into year end, we like carry. So we do think there's a narrow range for credit to trade in, and spreads will go a bit wider. But given how elevated yields are, carry is an attractive prospect for returns.
Do you ladder? Do you barbell? Do you single bullet? What are you doing here?
Well,
you need to make some money.
To my point earlier about investment grade supply, I think that there's a very positive technical on the long end. So we have lower issuance from investment grade issuers in the 10 to 30 year bucket. In our rate strategists, unlike some other calls across the street, we actually have constant, relatively steady 10 and 30 year treasuries heading into the end of the year. So we're calling for a 420, which we think could support long end performance.
The reason why some people say that the bulk of some of the rate increases haven't made it into the economy is because most companies haven't borrowed at these rates, particularly the lower rated ones. When does it start to bite in a more material way, where those that don't want to borrow, if rates are at this level and they have to borrow at 8-9% coupons, their business model does not work? When does that happen?
So we think it started to happen for floating rate issuers, and you have seen the leveraged loan default rate creep a little bit higher. Next year, we really think it starts to hit the fixed rate bond market in a gradual way. So for high yield, we forecast that about 13% of the market will have to refinance by the end of 2024. This will cause interest coverage to drop, and there's a lot of dispersion across sectors. So I think it really depends on the amount of lower quality issuance, a lower quality refinancing a sector is going to see, and that will really drive the impact to coverage. So some areas we see as more risky cyclical sectors, where places like tech and leisure, where you have not only the high maturity wall, but also this cyclical revenue exposure that we've talked about that could come down.
Megan Robson, thank you, of BNP Paribas, on some of the supply we've seen from high-grade companies in America, tons of it, to kick off the month of September, one of the busiest starts ever to the month of September. Tom, whether that continues is a separate question. The real test for this market, I think, is when the high-yield stuff starts to come down the pipe.
What's Luca doing in Cupertino this morning?
Luca
It's like the show's over. How many gazillion can we raise now?
Usually when Luca comes out,
calls?
it means one thing, Tom. Spreads are going wider.
Yeah.
That's usually the case with Luca's market timing. Fantastic market timer for whatever that's worth. Futures on the S&P 500, negative here by 0.08%. If you are just tuning in, welcome. CPI just around the corner. Equity futures down by 0.1%. Coming up, just after that CPI report, Tom Porcelli has a new seat. It's at PGIM Fixed Income. Very, very cool. His first interview with us right here on Bloomberg TV and Radio, Tom, following that inflation report.
This is the single best guy I know on wage analysis in America. He was a wonder child on it. He was brilliant. This guy understands job market and wage dynamic like no one.
And cost pressures and inflation and all of that. We need to recap this American Airlines story. A cut from Spirit an hour ago, a cut to the outlook from American Airlines an hour later. It really does raise the question, I think, Bramo, for a lot of us this morning. Who's next? Who are we waiting for now? United, Delta, who's next?
This isn't just oil prices going higher. There is something more, especially when you start talking about the cost of employment and you start hearing about that kind of pushback. Does this lead or signal a wave of margin compression that is not yet priced in? This is something that we've heard a lot from Michael Wilson. Do we see this continue from other sectors in particular?
To me, it's hugely behavioral. They got to put fannies in the seat. It's a fixed cost experiment. And in the headlines, capacity is still there. They're hyper managing, as Robert Crandall invented, price discrimination within the cabin. And look at the Paris trip, 7,000 whatever, 14 grand, 2 people to Paris. It's now under 7 grand.
Total revenue per available seat mile. This is the range from American Airlines, Tom. Negative 5.5% to negative 6.5. Previous range was negative 4.5 to negative 6.5. The outlook, not great. Coming up shortly, Republican Congressman French Hill of Arkansas on an impeachment inquiry in Washington, D.C. That's next. This is Bloomberg.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest in the nation's capital, Washington, D.C., that was House Speaker Kevin McCarthy. That conversation coming up shortly with Congressman French Hill, the Republican from Arkansas. Before we get there, just going into the inflation report in about 43 minutes' time in America. Inflation in America, the CPI report just around the corner. Equities look like this. We're down by 0.06% on the S&P, just a bit softer. Yields a touch higher by a couple of basis points, Tom, to 430.21.
4:30:21, and just a lot going on here. The countdown clock's helping me out today, John. 43 minutes, 4 seconds and counting here to the CPI report. It matters in New York. It matters in finance. You know what? It matters in Arkansas as well. I mean, it's that
big time.
It's just that way worldwide. There's no other way to put it. Joining us right now, the gentleman from Arkansas, French Hill, Republican. French, I got like 14 ways to go, ending with Arkansas football. But forget about that. Kevin McCarthy has a football he's playing right now. I read Cass Sunstein's magisterial book, Impeachment, cover to cover. It seems like we're almost downgrading impeachment as a concept of our civics lesson. Have we ruined the phrase impeachment? Have we bastardized it?
Well, you bring up such a good point, Tom, and that's how I felt during the Nancy Pelosi impeachment for President Trump 1 and 2. I felt like it was rushed. I don't think people collected the evidence. I don't think they even looked for the facts during those years. And that's why I was pleased to see McCarthy this year really encourage Jim Jordan in the Judiciary Committee and Jamie Comer, who chairs the Oversight Committee, and the same for Ways and Means with Jason Smith. Do your homework. Don't rush this. And so for the last few months, they've asked simply basic questions about, Joe Biden says he didn't know anything about Hunter Biden's business dealing. He wasn't involved. He didn't have any business relationship. And what they've uncovered is that those assertions from President Biden weren't true. And so that's what's led, I think, Speaker McCarthy with Jordan and Comer to take the next step to give them an extra clout in asking the banking and legal records they need to answer those questions definitively.
Do you have any sense, as an adult in the room, Congressman, banker from Arkansas, do you have any sense that there are high crimes and misdemeanors involved?
Well, one of the constitutional lists of impeachment items in the Constitution, of course, is bribery. And actually in the whistleblower testimony from the IRS agents and other people that have come forward, there is that suggestion that potentially there was a bribe involved here or a cover-up of illegal activity when Vice President Biden was in office and Hunter Biden was taking action here. And then it leads to the question, well, what's happened since President Biden's been president? The only way to get to those facts is simply have both sides present those assertions and look for the evidence and follow it where it goes.
Well, I look, French, I know Lisa wants to jump in here. These are really important questions. Where is this going to be into the Republican primary season? I mean, I understand there's theater here. There are partitions of GOP. You're in a certain partition. Where does your type of Republican want this to be in February?
Well, I think for all Republicans, all Democrats, and all independents, to get to the bottom of this quickly and promptly is important, and see where the facts lay out. Perhaps President Biden and Hunter Biden, their attorneys, their lawyers, can present evidence that those suspicious activity reports, the LLC formations, the $21 million in payments to those LLCs, et cetera, all are completely logical and don't have anything to do with President Biden today or as vice president, and that'll clear up the whole matter. So I hope it's over just as soon as possible. But we want to make sure that the work gets done in an effective way, and that's what I really do contrast it with how the Trump investigations were carried on by the House Democrats.
Congressman, in your Bentonville, there probably is less concern about the impeachment proceedings and much more concern about the UAW strike discussions. What this means going forward for worker earnings, what this means for negotiating power. What do you hope happens tomorrow at 11:59?
Well, again, this administration has been very pro-union, and they have taken the side of the union in every legislative battle. So I think that question's better left for the administration. Obviously, the United States doesn't need a strike right now, but this administration has had such a pro-union policy in every way, stretch, and form. I'm sure the unions are feeling quite empowered to take action. And that's concerning to me because I think the economy is at a very fragile moment.
That said, I was looking at a number of reports calculating what the earnings of some of these union workers were and extrapolating out to a 40-hour work week. It's about $35,000 to $67,000 a year. This at a time where inflation is continuing to rise and where we saw the biggest drop in household real income last year, going back a decade. What do you propose to actually increase wages at a time where, on a real basis, households are basically being taxed by inflation?
Well, first of all, stop inflation. And we could have done that if we'd taken our foot off the gas at the Federal Reserve in the fourth quarter of 2020 instead of doubling down and buying another $1 trillion of bonds and keeping interest rates zero. And if we hadn't unleashed an avalanche of spending to where we're now spending on an annualized basis over $6 trillion a year, when we were spending in FY19 $4.5 trillion. So beating inflation is the number one way to help working families.
Well, but Congressman, I guess that, and I apologize for interrupting, I guess that I'm wondering what the cohesive plan is at this point, other than saying, you know, the Fed. What is the cohesive plan? Yes, spending cuts, although it's been on both sides of the aisle that you've seen spending expansion. What is the plan in the near term to bring down inflation from your side?
Well, I think they are linked, and you can't separate them. I mean, the Fed's job's been made much harder because of the incredible fiscal stimulus and regulatory burdens put on by the 2 years of the Biden administration. And that's why in the debt ceiling deal, we propose to get more workers available for the workforce by encouraging work in the assistance programs, cut down regulatory burden, make it easier to get a project permitted, and cut spending and try to get spending back to pre-pandemic levels and stop having these huge budget deficits that Joe Biden has forecast.
Congressman Hill, a very serious question. We are so focused on 3 zip codes here, the doings of financial America and the global reach of Bloomberg and all. What are you hearing from small business people in Arkansas? The unemployment rate is low. Life is great. Arkansas is stealing for a game against LSU in 2 weeks. I get it. But what are you actually hearing from small business in your state?
Well, I spent a lot of time in August talking to businesses all over the 8 counties of central Arkansas, and I have to tell you that labor is still an issue for both white collar and manufacturing, where they're trying to find the right people for the right seats with the right training. And so Governor Sanders has really put an emphasis on workforce development. That's something I've worked on for the past 15 years as a bank president, as a chamber chairman, and now as a congressman. And so the technical skill attainment, and then just the bodies, Tom, it continues to be an issue. We have low unemployment in Arkansas, and despite inflation and despite all the economic challenges, that's what I hear about both with community bankers and with individual business owners when I'm at home.
Razorbacks at Tiger Stadium, TK.
They're going to get past BYU.
Are you proud of me, French, that I know all this now?
Yeah, it's just great.
I see engagement. We're taking a baby step forward, and the next step is to visit Razorback Stadium in Fayetteville.
That's up to you. We're going to make it happen. Congressman, thank you. Congressman French Hill there on the latest, an impeachment inquiry and the cost of living, Tom, in America.
Well, it is. In the inflation report, we were 34 minutes away from this key inflation report. And to me, John, the heart of the matter is the fancy people we talk to, like Rabila Farouk, have disinflationary tendencies in place. Our world changes with sub 3% inflation, except in Arkansas, that's not how they feel.
I've been surprised that presidential candidates have been going after Chairman Powell. I'm not sure how that polls. This is what you should do, exactly what French Hill just did. The reason why rates are high is because they've been doing XYZ in the White House. That's a more effective line of attack, I think. I mean, how many people in this country know Chairman Powell is and the Federal Reserve?
Are you busting my chops because I didn't know what Generation XYZ was yesterday?
Yeah, I am. Yeah. That's exactly what this is about. That's exactly what this is about. You're brutal. Daryl Cronk of Wells Fargo up
What's
next.
the connection?
The effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought.
I think the Fed absolutely has more ammunition in its tool belt to continue to raise rates closer to that 6% target.
They were already wrong once on inflation with the promise of transitory. They can't be wrong again.
The Fed's getting its way here. It's removing some of the demand, some of that froth, and yet not crushing the economy.
It's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. The countdown clock says it all. 29, 10, 9, 7. The gantry separates here.
You're going to keep this up.
The inflation report
Lift
in
up.
30 minutes. And what we've got is the airlines maybe telling Washington authorities what's really going on.
They're telling you two stories. Labour unit prices are higher, jet fuel costs are higher, and ultimately, here's the question. Can they pass it on to the consumer? That's what we'll be talking about in about 29 minutes' time when that US CPI report drops.
All sorts of ways to go here with this inflation report. Rabila Farouki, I think, with the comment of the day, looking for a modeled out sub 3% inflation out there somewhere in 2024. And the key thing, John, is how does it fold into what we do with markets? What does it do to the Saudis and oil? What does it do to the stock market?
Crude, 92. That's the number that matters right now, Tom.
Yeah.
89 on WTI. On Brent crude, 92.53. Headline inflation's going to be elevated because of gas prices. I think we all know that. It's baked into what we're estimating, actually. Headline to come in at 0.6% month on month. It's core. Where does core land? 0.2 is the expectation, which is why in the minds of so many, Tom, rate hikes are on ice at the Federal Reserve next week. But there is this risk. This risk is still out there that maybe inflation starts to pick up again. And that's why this Federal Reserve needs to be somewhat cautious, TK, about how things materialise into year-end and beyond.
It's out there. There's a toxic brew out there 28 minutes away. But, Lisa, the real question is, what do we do at 8:31? How do we readjust to what do we got? Line up the ducks, a UAW strike, tomorrow. Formula One in Singapore. Then we move on to a Fed meeting. We're going to London on a reduced fare. Did you see that?
I did see that.
Yeah.
Did you get a reduced fare?
I got a reduced fare. They said
I booked my ticket months ago.
Redo Keeper of the Amex said, Tom, you're not taking the Gulfstream. Move on. And so there we are. Lisa, what do you think of this? I mean, at 8:31, we recalibrate.
It's actually a really good question, which is what is going to move the needle, given the fact that everyone is looking at core, expecting it to be sort of in line and not really showing any reacceleration. Headline numbers, people are expecting to go up, and they don't really care. They're saying, it's transitory. The Fed's going to look past it. When does that headline figure really matter in a more meaningful way? Can the Fed be cutting rates next year if the headline figure is still running really north of 3%, north of 4%, even on the heels of oil prices?
Torsten Slock channeling Jason Furman up at Harvard. I've been talking this up, John, whether it's 3-month moving average or 3-month annualized. Slock publishes today the trend, the vector in non-farm payrolls. 700,000. He's out about the time of the Arsenal-Tottenham derby that we see next year. 20,000 positive. Wow. David Kelly at JP Morgan says a negative NFP. That begins to fold into the debate after 26 minutes away.
Thanks for the promo, because Torsten Slock's joining us, I think, in about 57 minutes' time on the Open on Bloomberg TV. So
That'll
we'll have this conversation.
Well timed.
He put out some great charts over the
He's
weekend.
Wear a Jets jacket?
I've talked about that over a couple of days. That's Mohammed on Friday. He'll wear
sorry.
a Jets jacket.
Okay, excuse me.
He's put out some great charts over the weekend, TK, about why he thinks maybe we are sufficiently restrictive. Away from the mortgage market, what you're seeing elsewhere. Delinquencies up, bank lending started to contract in various places, and that'll be a part of the conversation we have with him a little bit later.
Speed data check, 10-year real yield, 1.96%.
How fast? Just super quick? Equity futures down.
We got a great guess.
By 0.03%, yields up 2 basis points. Tom, your yield 430.
25 minutes, 37 seconds away. Daryl Cronk, Chief Investment Officer of Wells Fargo, joins us now with decades of experiment. Everybody's in a lather. Do I buy stocks? Do I add to my portfolio now? Do I go to cash? What's the mood at the margin with equity allocation?
At the margin, people are basically renting the market right now with a VIX that's at 14. You can use the options market with cheap premiums to get your exposure, but they're quick to sit near the exits. It's like your airline ticket to Europe. You want to buy the best seat and sit near the exit, right? And be ready to basically get out. So I think it's, we're stuck between this 4,300 and 4,600. All we've done is bounce back and forth between it. At this point, you need something to change in the baseline to really accelerate beyond the 4,600. Equity risk premiums are at a 19-year low. I'm not getting paid to take equity risk today.
Can we build on that just a little bit? Because I was curious too. I was looking back to the last inflation report. I think it was August 10th. Since then, the market's just been dead flat.
That's right.
And we've got the data we wanted to see, didn't we? Further signs of disinflation, growth still robust. What aren't we happy with?
So let's talk about inflation for a minute, right? When nobody's talking about this morning, everybody talks about the headline number, obviously going up because of energy prices. Everybody talks about core coming down, right? Which is important. Double click on core, right? Double click on core. What is Powell's super core doing ex shelter? It's going to go up 0.4 this month from up 0.2 last month, right? And it's still going to be running north of a 4% number and maybe even a 5% number. So if you think about, if you bookend this with headline, super core with core in the middle. Yes, core in the middle is a good story. Headline's not a terribly good story with the oil prices where they are. Super core's not a good story.
So what are we talking about here? What industries are sort of reaccelerating in a way that's catching the Fed's attention? Because I'm getting lost in the core, super core, non-core, how core. At a certain point, what is the Fed really keying in on if you are seeing housing costs disinflating on the margins? And, people are seeing goods prices disinflate at a pretty hefty pace.
Yeah, it's a good question, Lisa. So I would say, obviously, if you think about inflation, it's commodity prices, it's wages, and it's housing. Out of those three, housing is giving us some good data, right, in the form of slowing, right? You're seeing mortgage apps go down. You're seeing existing home sales come crashing down, actually. Rents are coming down, so that's good. Commodity prices and wages are still very, very sticky. So if you get into that supercore, why is it up 0.4 to your point? Travel, the travel is starting to fade now, basically, and health insurance numbers are fading. So the services piece, which is what Powell cares about, is still running much hotter than people expect and want. So I think you've got to really look into the data much deeper than what a lot of people are doing. They want to take the core and run with it. It's a little bit like, I'm going to use a John analogy here, right? It's Goldilocks and the Three Bears, right? It's the English fairy tale, right? Everybody wants Goldilocks to the equity markets, but your three bears are oil prices, interest rates sitting a few basis points off a cycle high, and earnings, right, which we're coming to the end of third quarter. Earnings growth is still going to be basically zero for third quarter, which is still going to be a challenge. So who's going to win that battle, Goldilocks or the Three Bears?
Given the fact that basically you're saying oil prices matter, and they're going to matter to the Fed, and they're going to matter to input prices for services that really count on oil. So what are you expecting? How high does the headline figure have to be to capture the market's attention to mean that the Fed has to respond to a headline figure that a lot of people say is very volatile?
I think the upside is calibrated well there. I don't think a headline number can get them off center for September. It may put November back into the conversation, right? But I think if you saw 0.8, 0.9 on the headline number, right, which would take your headline basically from, it'd put it somewhere around 4.7, 4.8, pushing a 5 number again. That would certainly get their attention, but they'd be able to, again, calibrate it to energy prices, and food prices have moderated some, right? But, I don't think the headline moves it for them. I really think the story is about core and super core, ex-shelter.
Do you think they're still willing to beat down growth to get inflation lower?
Yes, absolutely.
I didn't get that impression in Jackson Hole whatsoever from the people around that meeting.
Well, look at, so in June, 12 of the 18 members who have a vote on a dot, right, an SEP, right, still say there are more hikes ahead of them. That didn't change in July, right? We'll see if it changes here in September. So they're still saying Like, look, we've got at least one more hike. Now, again, the market's taken solace from that of like, that's the end of the road, right? It's kind of like one more for the road, right? One more hike and then we're done. And so they're taking solace in that, but it's what everybody talks about. It's keeping rates high for long and the grind that happens on growth.
I want you to talk to retail, institutional, Wells Fargo clients who have hit a home run with these 7 big tech stocks. They're all trading at 30 times multiple. So if I take a 30 times forward multiple Microsoft, how does that react given a presumed growth scarcity? Do they become ever more treasured and even sustain or trade higher in PE?
Well, that's been obviously the trade this year, which is when growth is scarce, right? You take whatever growth you can get, right? Which is the place you've been getting growth. I think what's interesting is if you break down things like the semiconductor industry, which is the darling, right? You've got now half of that industry in the S&P 500 below its 200-day moving average, right? It's failing technically right now. Consumer discretionary, half the names in the S&P 500 below their 200-day moving average, right? So under the surface, again, you're starting to see erosion and deterioration.
Are you seeing that in Apple, Microsoft, and the others?
Yes. They're all sitting, I mean, on a technical basis, the 20-day pierced the 50-day from above, which is a bad technical sign, and you're starting to see them fall down below the 50-day, which there's a big blue sky between the 50 and the 200-day, right? So what I would say there, Tom, is you're losing engines, right? If those were the engines for the first half of the year, right, think almost in terms of a plane, you're losing those engines that you need to really drive us forward here. And I agree with the conversation that you had yesterday about the consumer is stretched here, right? We have to pay attention to that.
Can we put some numbers on this just quickly? What kind of downside are you thinking about?
So we think the risk reward for equities, right, if you just use the S&P as a proxy, starts to turn around 4,200 or less. So it's probably, I'd much rather see it around 4,000, 4,100 to get equity risk premiums where they are, get multiples where they are. I mean, today, if you just simply take a 20 multiple,
you sounded super gloomy, so it's not that drastic. It's 300 points.
No, I don't think it's a correction, right? Yeah. And I think you use that correction to base off of for next year. But at 20 times earnings, right, you not only need earnings growth, the market's starting to demand it, right? It has to have it, right, in the back half of this year and early next year. So we've got to turn that at some point.
Daryl, this was thoughtful. It's good to see you. Always
you
is.
too, John.
Daryl Cronk of Wells Fargo. If you are just joining the program, welcome. We're counting you down to CPI in America. Equity futures right now on the S&P, totally unchanged, almost. We're positive by 0.01%. Coming up shortly, Tom Porcelli of PGIM Fixed Income to weigh in on that inflation data. Mike McKee's going to be with us around the table as well, as is Regina Mayer of KPMG, because on CPI Wednesday, TK, we have got to talk about the price of a barrel of oil, WTI and Brent, at new highs for 2023.
Regina Mayer brings a great scholarship to this, and next week in London, I believe we're scheduled to meet with Christian Malik, who's just brilliant on EM demand and such. And I made as a joke earlier the stew that's out there, but you look at the airline shortfall, what it's done to that sector, if you will, back to pandemic, literally back to pandemic lows. And the basic idea I would have is, are we going to get clarity here in 17 minutes, 15 seconds? And I'm going to say, yes, we are going to have a clearer picture here at 8:31.
On what do you think specifically?
The vectors, the 3-month. I'm going to 3-month annualized. I was trained to take 90 days of data and squeeze it out 1 year as a respectful guesstimate. And that's a raging debate among the nerds right now.
Where's the clock now, Lisa? 16 minutes and 51 seconds, something like that?
Yeah, I actually agree. I think that we will get a lot of clarity, but not because of the actual numbers, but because of how the market responds. I think it'll be interesting to see where the balance of risks are right now, not for the Fed, for the markets in terms of upside or downside potential surprise.
The 2-year yield came in a 5.04. I don't think that's a small matter.
I don't disagree. Yeah. It's near cycle highs.
Yeah.
Going into an inflation print that is set to show further signs of disinflation on core. That inflation report is about 16 minutes away, 18, live from New York City, 17, with your equity market 15, totally unchanged 20, on the S&P 500.
15,
this is Bloomberg.
Gantry's pulled away.
More likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think it's going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think.
Bill Dudley just nailed this Fed rate call a couple of years ago, the Bloomberg opinion columnist and former New York Fed president. I remember the conference. I was speaking to him, Mohamed Al-Erin. It was the summer of 2021. And Bill was talking about Fed funds going through 5%.
Yeah.
And at the time, Tom, I think we're all just shaking our head. What's Bill Dudley talking about? 5%. And here we are staring down a prospect to getting closer to 6. Never mind going through 5.
How did he do this? It was Dudley and McKelvey at Goldman Sachs. They had a young Turk, I think he was 23 years old, named Hatzius, who, picked up the coffee and be sure everybody was
He's doing all right
okay.
at Goldman now, yeah.
And in the crucible of market economics, he would crank this out. He is a lone duck in our monetary policy. He's been in the crucible, again, is the right word. He's been in the market economics of day to day. Very rare.
And he's now talking about higher for maybe even longer. Let's go through the price action together, just going into this inflation report about 13 minutes away. Equities are totally unchanged on the S&P 500. In the bond market, yields are a little bit higher by 3 basis points at 431. The dollar's stronger against the weaker euro at 107.31 into the ECB tomorrow. But here's the number I want to talk about. 89.20 on WTI. On Brent, 92.46. And for the airlines, it's getting tougher and tougher. Unit labour costs are up, fuel costs are up, and the outlook is not looking good. We get a cut to the outlook from American Airlines this morning, Spirit as well. Lisa, American down 3.26%, Spirit off by 4%.
And you could see the declines in commensurate airlines across the board. What's interesting to me is it's not just Spirit, which is more domestically focused. It's also American. This is a broad-based weakening when it comes to profits and the compression that you're seeing with costs going up, which raises a question, and we were talking about it earlier.
Oh, we're on the same page, Bramo.
Very
totally.
much. Is it just an airline story, or is this a broader economic story of what's to come in corporate America?
Can they pass it on?
Yeah.
Can they pass it on? So let's take crude. I'll go back to that framing we used in the last couple of hours. Is oil an example, a reflection of the extension of this cycle? Things are better than we thought they were, and we can absorb prices like that, or a recipe to end this cycle? I'm not just going to talk about crude. Lisa, let's throw in yields as well. A high yield's a reflection of the extension of the cycle, or a recipe to end it? 6
months ago, everyone said a recipe to end it. And then they were wrong.
Here
we are. And the economy just kept grinding along. Yes, we can exist at 5% benchmark rate. So if that's the case, are we misunderstanding some of the oil prices that everyone is saying is purely from supply cuts by Saudi Arabia? Is it also a demand side that could keep it going for longer than many people would like?
Can this economy get by with $92 Brent and 5% interest rates? We'll see. Inflation data just around the corner. Allow me to share the estimates with you. Month on month for headline, 0.6%. The previous month, 0.2, 0.6 is the estimate in our survey. Month on month for core, better reading. 0.2% previously, 0.2% in our survey. Mike McKee, you've got to break this one down for us in about 10 minutes' time. Mike, what are you looking for?
Well, we're looking at some of the categories that you just have been talking about. You and Lisa, airline fares have been down for 4 months in a row. They dropped 8.1% last month. Now, can that continue? That's something to keep an eye on. Maybe in August it did, but going forward with fuel prices up and now they got to pay these huge wage settlements, airfares could be going up again, and that's a fairly heavily weighted category in the core. We're also looking at shelter costs. Do we still see progress on rents and owner's equivalent rent coming down? And of course, everybody's favorite, used cars. Here's a tipping point. Is it going to change because the UAW goes on strike? The big three have very large inventories right now, so it won't matter for a while. But if it were a long strike, then you'd probably see used car prices go up again.
Mike, just to build on the oil conversation and this question of headline CPI versus core, at what point, based on your knowledge of the Fed and its history, what point does the Fed feel compelled to raise rates in the face of higher oil prices?
They probably don't, in that sense that they wouldn't directly attribute it to higher oil prices because the Fed can raise rates all at once and it won't push oil prices down. What they'd be watching is consumer expectations. Do inflation expectations start to rise because people are paying more for gasoline? And that would have an impact on them. But exactly how do you attack that is difficult when it comes to oil.
Mike, 8 minutes away here. First thing I did when I walked in the door this morning is went to my favorite Cleveland 16% number. Great series out of the Cleveland Fed. Which series away from this gives you a better core knowledge than core?
Better core knowledge than core. I mean, the Cleveland Fed is good. You can also look at the Dallas Fed has a trimmed mean as well. And a lot of Fed officials like the Dallas numbers. And also what's kind of interesting is it only gives us a sort of look backwards, but the consensus forecast of economists surveyed by Bloomberg is one of the most accurate of anything that we survey on. So if we come in at 02 today and we come in at 06 on the headline, that'll just show you pay attention to the people who have Bloombergs.
Mike McKee will continue with us here 7 minutes away from this important report. We're going to digress here. As John mentioned, what else matters? $92.45 Brent crude. Regina Mayer is Global Head of Clients Markets and Petroleum at KPMG with military service to the nation. Regina, thank you so much for joining us today. Your research note is demand, demand, demand. Are the Saudis aware of the resiliency and demand that KPMG projects?
Absolutely. So part of the supply challenge is it's against the backdrop of a stubbornly robust economy, but it is also a big supply part of the equation, right? We are anticipating supply drawdowns through the rest of the calendar year, Q3, Q4. And we're in probably the tightest supply situation that we've been in 10 years, 10-month crude highs that you've emphasized. But what I'm looking at are some underlying indicators. U.S. production is almost at its record high, 12.84 million barrels per day against a record high of 13 million barrels per day, with 17% of the rigs off the market. That's 127 fewer rigs, with the Saudis intentionally keeping barrels off the market. Right now, we're saying there's roughly a 3 million barrel per day supply versus demand gap because demand continues to go up. And we think OPEC's purposely keeping about 1.8 million barrels per day off the market. And there's no global relief valve in this environment. We can't rely on the SPR. There's no other source where we can turn on a tap and oil will flood back into the market.
Given the fact that production is so high in the United States, is that an indication that, yes, inventories are the tightest, as you said, going back 10 years, but this isn't as much about supply as it is ongoing continued demand, and that people are underestimating the strength on the other side that's also fueling some of these price increases?
Yeah, so we've been talking about peak demand. Potentially it happened pre-COVID. I think we definitely have put that in the rearview mirror. Right now, the EIA is saying average demand for 2023 is going to be over 101 million barrels per day. That's average. So last month, we just came off one of the hottest summers in a lot of years, and we're anticipating that's 103 million barrels per day. That's the 3 million barrel per day gap. And then the EIA is projecting it goes up to 102 million barrels per day in 2024. When is peak demand going to take place? Some are predicting it's this decade. Some are predicting it's next decade. Regardless of which decade you anticipate that it's coming, we know it's coming. So if you're a major oil company or a major resource holder, you're trying to figure out when's the last marginal dollar of additional investment that I'm going to put in to grow supply against a backdrop of ultimately that supply is going to be in excess of demand.
Given that backdrop, if there is a recession or some sort of downturn, a softening in the economy, could that offset the tightness in the oil market? In other words, could oil prices come down sharply in a surprise, even with all of these technical backdrops, simply because you do get a weakening of the consumer?
Absolutely. I think if we start to see more signs that the economy is slowing down, you will start to see oil prices come back down. We are seeing the potential for supply rebuild in 2024. So it's really just this 6-month period. I know there are some that'll say it's triple digit for longer that's coming. I think there are bear signs in the market. But right now, frankly, it's all upside, very little downside.
Regina, just one final question here. With great respect for your bringing in international relations into the KPMG oil debate, does the United States of America have an energy policy?
I think we have different aspects of energy policies. I think some of the things that we've just recently seen on Anwar is more politics versus substance. It would have taken billions of dollars in investment to get drilling production and then moving that material to market. We would be best served to focus on where are our great sources of resources, Gulf of Mexico, onshore and conventionals, other dry gas plays. There are lots of different factors that slow down the ability for our industry to exploit those resources. I do think there's room for a more coherent, more effective energy policy overall.
The policy is lower prices, TK. I think that's the policy. We just want lower prices. That's kind of it.
Dead on.
Regina,
actually.
just quickly, when does demand destruction start to kick in? Aren't we already thinking about that in the 90s?
For sure. I mean, I think if gas prices go substantially over $4, we're at the end of summer driving season, and U.S. gas prices are 12 cents per gallon on average higher than they were this time last year. That's probably not enough to drive demand destruction, but some of the things that you are all talking about relative to airline airfares, the pinch that people are starting to feel relative to how confident they feel about the future, how confident they feel about their savings cushions. I do see some of those pressures that could dampen demand as we move into the fall and the winter.
Regina Mayer of KPMG on the oil market. Regina, thank you. Crude, Brent through the 90s, WTI getting closer. The inflation report about 2 minutes away. Given what we're discussing here, what's more important, inflation in a couple of minutes or retail sales tomorrow? Drew Madison, MetLife, writing in, inflation trends is unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change
Totally agree.
Thinking. That number drops, Tom, tomorrow morning.
I have it right down in front of me. I brought it up just as Drew was probably right in that. The idea, I agree, retail sales dovetails in here with a GDP adjustment given any shocks, and then that goes into where Torsten Slok is in your 9 o'clock hour, which is the non-farm payrolls coming down.
Elisa, that speaks to the question you've been asking all morning.
Yeah, well, this to me is at what point is retail sales a reflection of whether higher inflation is essentially eating into discretionary spending? And that's to me the issue right now that we're facing off with. And that's the real question. And retail sales is the kicker to the chaser, which is really what we're going to get today. And ultimately, we just don't know because it might have been boosted. We saw that, some of the peripheral data, there was, Amazon Prime or whatever, and people are back to school. And when you strip out all those distortions, what do you get? It's always been stronger.
You said something earlier on this week that I think is really important, and I saw it in Citi Research as well, so they agree with you. When the data starts to contradict, we're at turning points. And Citi said the same thing, Bramo, and there's a lot of data out there at the moment that seems to be contradicting with each other. Claims are super low, and then you look beneath the surface of the jobs market, you start to see some cracks emerging.
I was speaking with a policymaker, and I was saying to them, is the data manipulated? Is it fake? Is it the idea?
Massaged.
Is it massaged? Is it this people aren't really responding to all of the surveys? Is it messy? Is it inaccurate? And they just looked at me and they said, this always happens at these moments.
Yep.
We just don't know which way it's going to turn. It is too facile to simply shrug it off as wrong.
Inflation data 15 seconds away. Going into it, equity futures on the S&P just slightly lower on the S&P 500. Yields in the bond market on a 10-year up by a couple of basis points. On a 2-year, 5.03%. Yields higher there by a single basis point. With the economic data this morning, here's Mike McKee. Morning, Mike.
Well, I said that economists were pretty good at forecasting, and they were pretty good at forecasting this time, except for the core there. It comes in a little hotter at 0.3 on the month, which pushes the year-over-year core to 4.3, still what had been forecast. The headline is up 0.6%, and that is what was forecast. And so the year-over-year number rises to 3.7% from 3.2. That's a tick higher, so it looks like perhaps that 0.3 was a revised up number. Let's take a look at some of the categories here. Food prices up only 0.2, so no real change there, but we get a big jump in energy prices. Gasoline up 10.5%. No surprise, I don't think, to anybody, but it definitely has a weight on this index. Used cars and trucks fall again 1.2%. They're down 6.6% for the year. So that puts pressure on the other direction. And then, of course, services, less energy services up 0.4, but that includes a 0.3 gain in shelter. So let's see what the markets are doing. I'll get you some more numbers here in just a second.
I'll start with the bond market, Mike. Stay close. I'll come back to you in just a couple of seconds. So that small upside surprise on core inflation lights a fuse under the dollar. The dollar is a whole lot stronger off the back of this. Yields are a whole lot higher in the bond market, up 5 basis points on a 2-year, 5.07%, call it 5.08 on a 10-year yield, higher by 6 basis points. So the whole curve a lift here. Yields pushing higher right across the curve. 2's out to 30s. Got a 10-year higher by 6 basis points at 434. 30 are up by 4 basis points to 439. But it's that 2-year piece of the curve that gets your attention. So yields up. Dollar stronger, euro dollar holding on to 107 again at 107.18, and equities just a little bit softer here. We're lower by about 0.25% on the S&P 500. Mike, you've had time to take a second look. What stands out for you now?
Well, we were talking about airfares before the numbers came out, and airfares did rise 4.9% during the month. So that is important. Now, breaking down the housing numbers, we see shelter, as I mentioned, had been up 0.3%. Owner's equivalent rent up 0.4%, but rent of a primary residence up 0.5. That's a rise from the prior month of a 0.4 gain. So it does suggest that there is an issue with housing still not coming down the way that the Fed would like to see it. Overall, this is probably neutral for the Fed, and we can talk about the idea that perhaps we see retail sales have more of an impact, but hard to say at this point that anything will derail them from a September hold.
I've got a derail, Mike. I got yen out to near 148. That gets my attention. It's a global distraction, but I've got a 10-year real yield out 3 basis points, popping to 1.96 right now. We even saw 1.98 seconds ago. Does an elevated real yield figure into Fed calculus?
It does over a longer period of time. As inflation comes down, obviously, real yields are going to rise. So the Fed has to keep an eye on that. They don't want to get any tighter than they feel they must be. But that's a long way away, and inflation on a headline basis for the CPI went up. Remember, the PCE is the Fed's indicator, and that has been moving at a slower pace than CPI. So the Fed is not overly concerned about where we are with real rates yet.
What I find interesting, Mike, just in the price action of the markets is that the long end is also affected in tandem with the short end. It's sort of this feeling that this robustness of the U.S. economy can continue even with rates where they are, even despite all of the negative discussions. From your vantage point, is it surprising? How surprising is it that we got some of these upside surprises in the core element, which was exactly where everyone was expecting to see the softness that everyone was hoping for?
Well, it is obviously a bit surprising. On a year-over-year basis, base effects mean that we don't lose any ground. We see the core year-over-year come down some. But the services prices, and we have to dig into that even further, the services prices are going to be a concern for the Fed. Now, one of the things that we had seen in the past is that commissions on Wall Street had gone into the CPI and the PCE and pushed up that services X housing number. And I haven't gotten that far into the data yet, but that's something to look for as well.
Mike, we'll come back to you a little bit later. Looking forward to catching up. Let's run through it. The fun and games lasted about 60 seconds. The whole move has faded since then. Equity futures basically back to where they were on the S&P 500, negative by 0.1%. In the bond market, we look a little something like this. Treasuries, 2-year, 10-year, 30-year. Yields higher, but that move fades as well, up by 2 basis points on a 2-year to 5.04%. And if you take a look at the chart of the euro, if you can access one, basically back to where we started. We're negative 0.2%. Dollar's still stronger, 107.32. To discuss a little bit later in the next hour, Torsten Slok of Apollo, Caterina Simonetti of Morgan Stanley, Robert Tipp of PGIM TK, all of that in the next hour on Bloomberg TV.
So nothing burger, and what does it mean for retail sales tomorrow?
Basically
it's that simple.
That's it. 60 minutes of that,
Are you okay there?
on Bloomberg TV. That's the tease.
We're going to continue right now. And speaking of Mr. Tipp at PGIM, joining us right now is Thomas Purcelli, Chief U.S. Economist at PGIM Fixed Income. outcome. He's definitive with work on the open market desk at the Fed, and also truly great work on wage dynamics in America. Congratulations on the new shingle across the Hudson.
Thank you, sir.
As simple as I can, I want to go to your wheelhouse right away. You're talking to Greg Peters, which is really difficult. You've got to, prepare, medicate yourself.
He's the best. Loving the pieces.
You're talking to Greg Peters here, and he's going to turn to you just like I am and say, okay, but what about wage dynamics? That's what you own the high ground on. How are wages in America into 2024?
Yeah, look, I think here's the problem for the backdrop with regard to wages, which, look, in real terms, I think we'll appreciate are sort of performing decently. The challenge, though, is if you have real revenue that's moving sideways, right, which it is, and you have, which obviously is a function of the consumer that is sort of slowing down to some extent. How do companies respond to that? How do companies respond to real revenue moving sideways, wage pressures firming up a bit in real terms? I think that, to me, that's a perfect recipe for companies to go after labor, particularly if it means you're going to get a margin compression, which is something that we've been talking about for a while. And I think, Lisa, you and I talked about that last time I was on. That, to me, is a challenge as it relates to sort of the labor dynamic in the United States.
To translate this, they're going to be layoffs. That's basically what you're saying, is
absolutely.
that if you see this incredible margin compression, if you see costs going up, and you see consumers pushing back on prices, the next step is people are going to lose their jobs. How much pushback is there actually to pricing if we're still seeing robust services side inflation, as this report just suggested?
Yeah. So, and what we know is that wage pressures, again, remaining firm in real terms, but it's coming in the context of inflationary pressure that's now slowing down. I mean, this 2/10 that we got, I get it, firmer than expectations. But that still doesn't change the trend. The trend of inflation is actually moving slower. So that means that the pass-through is becoming much more difficult for companies.
Well, but we're seeing this, we saw this with American Airlines and Spirit earlier this morning. So the pass-through is getting more difficult.
And sorry, no, I was just going to say, Lisa, I think it's such an important idea. Not only do you have that idea, this dynamic where the pass-through is becoming much more complicated, but just look at what some of the retailers have been talking about. I mean, the consumer is now trading down. Right? I mean, just in the context of these wage pressure, these inflationary pressures that are out there, I think it's such an important idea.
The problem with it is, and this is what I'm struggling with, and I think a lot of other people are as well, we were saying this 6 months ago. We were saying that consumers were going to push back and that savings were going to be beaten down. And suddenly, we were going to see, a recession. It didn't happen. And the data just keeps surprising to the upside with this yet another surprise to the upside in core. How can you explain that?
Yeah, so I think there's a really easy way to explain it. So, in fact, there's a couple of ways to explain it. So one, the idea of excess saving is real, right? I mean, and the consumer is still working that down. So let's just be clear. The consumer has had a massive pool with which to sort of dive into. Excess savings was one of those ideas. The other was credit. I mean, credit usage has been, sort of off the charts. I mean, you're looking at revolving debt that's now running at $1 trillion. And so the consumer has been able to sort of perpetuate the sort of the consumer backdrop as a result of these two ideas. But just to be clear, that now is sort of drying up a little bit, right? Excess saving continues to fade. It's not gone. It continues to fade. Banks are now actually getting pretty stingy as it relates to how much credit they're willing to sort of lend out. And we can see that in, obviously, banks' willingness to make these kind of loans. And so I think the whole this backdrop is drying up, right? The ammunition is drying up for the consumer to some extent.
What I think is so important here is, and with Robert Tipp coming on in the next hour with John, you've got to turn to a bunch of bond animals with the ambiguities between your economics and their portfolio management. Can you assume a disinflationary tendency means price up, yield down in bond portfolios? Is that just a given? Yeah, so I think this is a really important idea. One of the things that we've been talking about at PGIM is this idea that rates can stay high, rates can stay pretty elevated. And I think that you can have rates remain pretty elevated. I mean, when I think about sort of the Fed's reaction function to all of this, and again, I get it. On CPI day, we're talking about inflation. But the thing that I keep on coming back to, and I'm trying to bring it back to this today, here now, is the labor backdrop. Because I think when push comes to shove,
I think the Fed's going to be very responsive to the labor backdrop. So I can easily make the case for the Fed to engage in an easing cycle. Now, I think when people say easing cycle, I think they immediately think of, hey, this big aggressive easing cycle. It's not going to be that. I think it's a dynamic where the Fed cuts back.
Their easiest path within asymmetry is to go longer. To stay elevated and go longer. I agree.
100%. And so to me, that's sort of the big challenge here for the Fed. I think it doesn't have to be a big aggressive easing cycle if it's not going to be a big aggressive slowing in economic activity.
Come in 25 or 50 beeps and just sit on it through 24.
I think that's exactly right. So our call has been, you can easily see a dynamic where the Fed cuts, call it 50 to 75 basis points over the coming year. And I think that's how you sort of get to this dynamic where rates still remain pretty elevated.
Which is the reason why I wonder if Goldilocks and soft landing is the best case scenario for risk assets, or if it's actually the worst case scenario for risk assets over the longer term, particularly corporate credit, when you face off with this idea of refinancing. What's your view? Is that potentially problematic?
So it can be, right? I mean, I think the rollover risk idea will become a challenge, but that's not a challenge for necessarily right now, right? I mean, a lot of companies have done a great job of terming out their debt. One of the things that we've been talking about at PGIM and Dilip, my boss, I think he's been absolutely fantastic about highlighting this really important structural idea that's out there. I mean, which is something I've been talking about since my prior life. I think that the pieces are in place for productivity to really kill it. I think that's going to take time to develop.
Right.
And I think that, Lisa, is basically that's another really important idea to insert into your question.
We got to go. When you go across the Hudson River, does Peters let you use the Hinckley picnic boat he's got? Are you using the little Hinckley thing that takes you over to PG?
I'm just happy to be around him.
Okay. Tom Porcelli, thank you so much. Say Robert Tipp as well. He'll be here later. Mr. Porcelli is with PGIM. Fixed income markets, I'm going to call it flat. Standard & Poor's 500 down 0.1%.
Right now, I'm actually looking up Hinckley Pinkley because I have no idea what that is. I've got to be honest. What is that?
Hinckley picnic boat is
amazing
what Porcelli goes large on it. It's got side turbo thrusters, so you can just ease into the dock and Nantucket.
Okay, good to know. This is I'm looking this up. This is probably it gives you a pro
when
tip.
you get done with the Grand Banks, you get the Hinckley picnic boat.
So if anyone is tuning in and trying to figure out what time is making up and what is not, or what he's projecting onto me,
Peters is gorgeous. He got the light blue,
all of these
the eggshell blue.
Boats, maybe you're projecting. Honestly, I'm just trying to put this all together and to understand the upside surprise in core, which was exactly what people didn't want. They thought we'd see an upside surprise in headline.
We got to.
I disagree, because it might be nothing burger right now, but put together with that 3-month rolling trend, just gives you this feeling that people are overestimating the downside surprises. Maybe. This is what I'm kind of taking away from it.
I'm with Porcelli on this. I think the jobs day all of a sudden became more important here. Get out the calendar. We're, first week of October, we'll be to it. Stay with us with futures at -10. On radio, on television, this is Bloomberg.
We think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer, being the biggest part of the economy, is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months.
This is Larry Adam earlier this morning, Chief Investment Officer at Raymond James, talking about what a soft landing means, because we always are looking for definitions as people cling onto these words that have very different meanings depending on who we're talking about. We've seen the moves fade, Tom. It was a pretty significant move in some of the Treasury yields, in particular in the dollar, and it's kind of just sort of shrugged off as people take a look and say, it's a month.
I'm going to go all David Rosenberg on you. Rosenberg used to write at Merrill Lynch with Mr. Farrell, and about page 3 or 4 of his report, which was read street-wide, this is before the internet, Lisa, where theft was in order, and on the right side, he would list all the components of inflation. And the phrase I use is Rosenberg slices and dices like no one. It takes time to go through the 85, 90, whatever it is, slices and dices. So we're going to have a different view of this inflation report. Not here. Do we do a count-up clock? Once we do countdown, do we count up afterwards? We're 17 minutes afterwards, and Rosenberg's, he's got a Labatt's poured, and he's like trying to get through it by 12 noon.
Well, the data now continues, but in more granular form. And you say, what goes up? How do companies deal with this? We did see airline tickets actually tick up in this latest report. As we hear about some of the margin compression at a number of them, I want to take a look just quickly at American Airlines and Spirit, which came out earlier today, revising downward their earnings outlooks. We saw EPS downgrades at American. We saw revenue downgrades at Spirit. Those shares down both 3.6%, 3.7%. They've come off some of the lows. But to me, this really highlights this question, what do companies do? As we were just hearing from Tom Porcelli, what do companies do when their input costs are going up and their prices are not necessarily being received well by consumers?
I get criticized. It's been a theme for me for 18 months. Corporations are going to adjust. They're adjusting in rapid speed now. And what the airline thing today signals to me is just the continuum away from the pandemic. It's like we're in some new phase after we all traveled like idiots. We're all the same on this. We all took the 7 flights we didn't want to take. And all of a sudden now it's now what for the airlines? I'm fascinated by what they say. I know we're speaking with Hurley from JetBlue here coming up on Bloomberg. She is grizzled financially about what do you do in the room when you face $93 Brent.
It's a larger story, though, also because it's not just energy prices. We heard this from American. It's also labor. It is a pushback there. And these two polls are really creating a confusing toxic stew, which creates the situation of we don't know how companies are going to respond. Are they going to hoard labor, or are they going to take the Tom Porcelli route and start laying off some workers?
Well, the ambiguity of it's interesting, and it leads to the jobs report. And as a number of you said, emailing into me, the retail sales report tomorrow. Joining us now with wonderful perspective is Rob Waldner, Chief Fixed Income Strategist, Head of Macro Research, owner of the High Ground at Invesco. I was thrilled that he could join us today. Rob, ambiguity in microeconomics is you really don't know which way the curve is going to go. In fixed income, I got lots of ambiguities, mysteries, uncertainties right now. What's the lead ambiguity for you and Invesco?
Well, I think if we're trying to look at the ambiguities, let's look at where the market action today. So, I think, we saw that CPI was slightly disappointing from a fixed income perspective, i.e. core came in a little bit higher month on month than we were expecting. It keeps a disinflationary trend in place, but nonetheless, it was a disappointing number. And I think, as you pointed out earlier, you can't really tell on the market. The market's behaving very well. So I think that tells you that the market is not fully bought into this disinflationary trend idea, and tells you that the market is more worried about inflation than maybe it needs to be.
In a given bond portfolio, and there's 472 of them at Invesco, of flavors, I should say, of portfolios, the basic idea is you have to adjust. How do you adjust a bond portfolio now? Is it a duration dynamic? Is it a portfolio structure dynamic? What's the variable of action into the fourth quarter of this year?
Well, Tom, as bond managers, we really have two components to yield in our portfolios. One is the overall level of yields represented by the Treasury market, or real yields in the Treasury market, and the other is credit spread. And I think when we look at the balance now, going into the fourth quarter and going into 2024, we've been of the view that we would have a bumpy landing, but with a growing risk of a potentially slowdown in 2024, further slowdown. And so in that environment where we've seen real yields come higher, so the real yield component is higher, and the spread component has shrunk over the balance of this year, I think that favors putting more of your resources towards real yield. And we know that the market itself has been putting money into money market funds instead of into duration. We have, close to $1 trillion of money has flown into money market funds this year. So that tells us that the market is not valuing duration and real yield as much as it should be. And so we would be reallocating towards that sort of longer duration real yield into more traditional bond portfolios. and using that as the core building block of our portfolio structure.
Let's build on that, Rob, because you said that what we have seen today in terms of the market response to today's report was that the market hasn't bought into this disinflationary idea, has not bought into this disinflationary idea, and that they're maybe more worried about inflation than they ought to be. How much are you loading the boat right now? Are you basically just going out and buying every 10-year Treasury note that you could possibly find, saying this is the time to lock it in because it's not going to last?
Well, we do think we're at the top of close to the top of the near-term range, Lisa. So, I mean, load the boat. I'm not sure we're getting overweight from a bond perspective in high-quality credit, and we think that's a good buying opportunity.
When you say high quality credit, I'm wondering how much we're also talking about corporate credit. At what point, when we talk about margin compression and this question of what do companies do with the fact that their costs are up and they cannot raise their prices commensurately, how much does that weaken corporate credit as opposed to improve it at a time when the revenues were increasing and they didn't have to refinance yet?
Well, so the fundamentals, I think you're driving here at the fundamentals behind the corporate sector. There's no doubt that I would put it slightly differently as you did, but I think I'm saying the same thing. No doubt that very high nominal GDP growth that we've had over the last couple of years has been very, very supportive for the corporate sector.
Right.
And as that nominal GDP comes down, so nominal GDP growth now in our estimation is running somewhere trending around 4 to 5%. So we're now down below the level of interest rates. That is going to put pressure on the economy overall, and including the corporate sector. So fundamentals will be less positive going forward, but the offsetting benefit will be if you're in longer duration bonds, that you will get some benefit from that duration.
Rob, I did a wonderful panel last week with Christina Campany. We all didn't like her. She stole the show, which was unfortunate. But your Christina Campany made real clear, as you stated, that with a reduced nominal GDP, a reduced animal spirit, things change. What will CFOs of corporate America do?
The problem is people will get squeezed. CFOs will get squeezed if they don't have that pricing power that Lisa was alluding to, which is the same thing as saying nominal GDP comes down. I think CFOs are in a pretty good place in that they've, as far as we can tell, in terms of financing, there's not a lot of near-term financing needs. So it'll be more of I think, Tom, it'll be more of a sort of longer-term, as things reset higher, squeeze rather than an immediate impact. But it is going to be more difficult to manage through an environment where your top line is not growing as fast as your funding costs are going up.
Rob Mulder, thank you so much. With Invesco. Lisa, this is so important, and I'm going to go back to a huge mentor and someone of great influence on me, Philip Correa, who we enjoyed living to 104. He was brilliant. He was inquisitive. He founded Pioneer Funds up in Boston. And Mr. Correa would say to me, the young whippersnapper on the elevator, he would say, Tom, don't forget the bright lights of inflation. And under the bright lights of inflation, it's easier for CFOs. Inflation helps people feel in the real time that things are great. It's getting a little dimmer out there right now, is how I'd put it.
It's a transition moment. And what we're transitioning to is the really big question that we just don't understand. But it's getting harder for the CFO to understand exactly how to navigate. What
timing? Matthew Miller in conversation with the CFO, the financial X at JetBlue, Ursula Hurley, perfectly timed given the challenges of the airline business. That tonight.